Good. So I'm going to talk about trading strategies. I mentioned at the beginning that the act of investing is turning risk into return. So the risk that you consume will determine the return that you get. And the risk that you consume is part of a natural taxonomy of investment strategies. Different investment strategies will consume different risk and will give you different return. And that's what I want to focus on today. I like to start talking about hedge funds because hedge funds give us the richest variety of risk consumption. We already went through that the other days. If you have mutual funds, they all do the same. If you look at infrastructure funds, they all do the same. And this is the beta component of most investments. So the risk factor analysis is very simple. But once you get into hedge funds, that's where we have the richest collection of investment strategies. Hedge funds are companies, enterprises that turn risk into return. And they do that usually through market inefficiencies or information advantages. And the first day, our Snow Fund was a hedge fund. We already built one. So we are experts on what hedge funds are. And the return profile is not directly linked to market direction. That's what they say. For us, what that means is that if you try to do the analysis, the regression analysis, as you did yesterday, we should get no market direction. Now, yesterday was a failed attempt. You actually got a market direction. That's not supposed to happen. I suspect the reason is because we used not a real hedge fund, but one of these so-called replicating strategies, which are fake. And maybe what you proved is that they're actually fake. Maybe that's the result of what you did yesterday. But so yesterday in the afternoon was a bit of a disappointment because what you obtained is not what I know to be the case. Perhaps it's because we didn't have access to the real hedge fund data. We used some fake hedge fund data. Maybe you proved that it's fake hedge fund data. You're not supposed to have that. But anyway, I have to tell you that, and now there's no way for you to prove it because we couldn't get the data to do that. And they trade sometimes exchange-traded securities like stocks and futures. Sometimes they trade OTC, over-the-counter securities, options and bonds, and sometimes some specialty products that we will see today. And they may have a limited opportunity set, just like our Snow Fund. We saw that our Snow Fund could not really grow beyond $2 billion. $2 billion for a mutual fund is nothing. That's a very tiny mutual fund. But for a hedge fund or some of these specialty investment products, this $2 billion is a lot of money. And it may have liquidity restrictions, as we already saw for a Snow Fund. We saw that we should give at least annual redemption potential to our investors, nothing better than that, because it does not align with our obligations in the securities that we have in our portfolio. And they're very often innovative, not always. Sometimes they do very old things, but most of them, they are really ahead of what investors do. If we had access to the data, we would have seen something like this. What I have here is the risk-return scattergram of the different strategies that exist. So today I want to talk about the strategies, and each strategy carries a certain risk-return profile, which you can summarize in a scattergram like that. You can see that some of them have, here I have a return on the y-axis and risk on the x-axis. And you can see that some of them have a very high risk and not very good return. Some have very low risk, very high return. But one thing that investors in these strategies typically never do is they never say, oh, that is very high risk, low return. I'm going to ignore that. No. The reason we don't ignore them is because the biggest, most valuable characteristic they give us is the diversification benefits. If you pick them correctly, they not always, because they consume different risk. When some of them underperform, others could outperform. And understanding that is critical to building a stable portfolio. So we will go through some of that today at some point. I want to start with the simplest style, which is the equity style. I want to talk about stocks. I want to talk about trading stock, not just in the context of a hedge fund, in general, how stocks are traded, how people buy and sell stocks. And I need to remind you of something I said yesterday, which is a stock is never created so people can play a game, the buy and sell game. The stocks always exist because there's a business behind that needs financing. And everything starts with that. So the act of investing is the act of participating in the risk that the company is taking. And this is not, typically that is not captured by its valuation on the stock market. The valuation of a stock in the stock market is a one-dimensional projection of a very complex set of circumstances. So you have a company that is very cheap on the stock market, but the complexities of the stock could be big. And I'll go into some of that now. The equity trading is the biggest style that exists. There's a lot of different ways of doing stock trading. I have here 4 that appear in this list of trading styles. There's equity long only, equity long bias, equity long short, and equity market neutral. What does that mean? There's 4. And they're all characterized by the balance between, which is your exposure to the index. Expressed in the context of your first exercise on day 1, where you calculated the main risk factor on a stock market, all these 4 are characterized by your exposure to that. So long only is the one that has 100% exposure to the equity index, either the DAX, the S&P, or your own eigenvector. And these are the ones that buy stocks, and that's all they do. They only buy stocks. Because of that, they're going to have a very high exposure to the first eigenvector or to the market index. That's long only. Equity market neutral is on the other side of the spectrum. They have 0 exposure to that. You would do the regression as you did yesterday on a true equity market neutral, and you will see that the correlation is practically 0. May go up and down depending on the market conditions and whatever the manager thinks that the optimal risk exposure would be. But typically those, we're going to see them today. Typically those, they have no exposure to the market. So the market goes up, the market goes down. That carries no information about the performance they have. That is the equity market neutral. And we're going to see them in great detail. So you can invest in stocks without being exposed to the index, and that's what they do. Those are really not exposed to market direction. Then we have equity long short, which is they go long, they go short, but they decide what the exposure to that vector would be. So sometimes they may decide they want to have, for example, 70% long exposure. That means that if you do the correlation to the index as you did yesterday, you're going to get a correlation which is about 0.7. I forgot what number you obtained yesterday, but it was clearly not a hedge fund that we were working with, so I'm not interested. But sometimes when, for example, I don't know, maybe Now, many equity investors would consider investing in equities now very risky, and all-time highs, lots of uncertainty, geopolitical tensions. So you know what? Now I go to zero, or even I go negative. It's rare to go negative, but that's what they do. They decide what exposure they want to have to the market. And then you have the long bias. The long bias is a type of long short where they typically, these are people who are either, they are very long-term thinkers. They said, you know what, yeah, I may have a bad year by going long, but they do that. They don't like to have short-term strategies because they think they're not good at understanding where the markets are going. Understanding market direction is impossible. You cannot predict market direction. No one has been able to predict market direction. Not with AI, not with fancy algorithms, not with anything. So this idea that you know if the market is going up or down tomorrow, forget it, no one can do it. This idea that you know this stock is going to go up or down tomorrow, forget it, no one can do it. That is not how investing is done. Okay? So the first thing that we're looking at here is you decide the risk you want to have to the market. Your decisions, as we will see, are going to be slightly different, but you have to decide what your exposure to the market is going to be. And this defines the four main areas. There's many more that we have. For example, quant equity is not here. This is a style that they would trade, 12,000 stocks on a given day. They start the day at 9:30. They typically trade in New York. So 9:30, it's 9:37, but it's 3:30. It's 3:37 in New York. But if it were 9:37, they start trading, and by the time the day is over, they have nothing. They take advantage of very short price moves. That's a style I'm not going to review here. There is very little to say about that style, except they follow this algorithm that works, but there's really nothing much of interest to teach about programs like that. And there are very few managers that do that. Very few managers are these quant equity, where they would do thousands of trades per day. High frequency trading is not here. It's not something different. It has nothing to do with this. High frequency trading is a style that its main objective is to front run Bloomberg. Front run means to do something before someone else does it. So front running. Sophia is going to buy Apple stock. And she's a very big investor. She's going to buy millions of dollars of Apple stock. And I know it for whatever the reason. She told her friend while she was having a coffee, and then I overheard that. They said, oh, Sophia is going to buy a lot of Apple stock. Then I buy it before she does. That's front running. Do I know Apple stock is going to go up or down? I have no idea, except I know she's going to buy a lot of it. So yeah, it'll go up. Once I know, oh, she's done, she already bought it, then I sell it. That's front running. Okay, it's legal, and there's no problem with that. If the information I have received is not, if you are the CEO of Apple, and you tell me, and I hear, and you tell me, if I hear that's a different issue, but if you tell me you're going to sell your shares because you're scared about the company, then I cannot trade. I cannot sell the shares before you do. That will be insider trading. Both you and I will be in trouble. Okay? So there are a lot of nuances about these things, and of course there's no way I can explain all of those things to you, but I'll try to tell you enough stories today so that you get a complete picture of how these things work. And this is part of the information advantage that some of these funds have. One of my favorite funds, hedge funds, is this one operated a few decades ago. And it was a fund whose objective was to front-run Korean housewives. I will explain. The culture in Korea, similar to Japan, is that women should not work. Wealthy women should not work. So you have a lot of households where husband and wife live, both very well educated, prime university, prime degrees, but the culture, the tradition is that he goes to work, makes a lot of money, but she stays home. She's bored to death. And she has friends who are just as bored as she is. So they talk to each other. And maybe they have a degree in management. So they say, you know what? Why don't we buy stocks? And that's what they do for entertainment, right? And there's this hedge fund whose objective was to figure out which stocks they liked and buy them before they do. And at the same time, find out which stocks they are going to sell and sell them before they do. Front-run Korean housewives. You understand? Now, that is not a style which is here. I don't, but it's just to give you an idea of how far trading strategies are and the value of information when you do that. If information is legally obtained, no problem. If it is not, if it's protected, then you cannot do that. And this protection was created in the year 1933, 1934. You may have heard about the market crash of 1929, have you? Big market crash, 1929 was the beginning of the Great Depression. You heard about that? 1929? Yes, no, you must know that. You must know that. No? Okay. If you are Americans, I would ask you if you have watched the movie It's a Wonderful Life. Have you watched that movie? I'm sure you have watched that movie. Especially the Germans, I'm sure you have watched that movie. Very likely at Christmas time. In America, everybody watches that movie at Christmas time. It always is on the networks at Christmas time. James Stewart, he's about to commit suicide, and then the movie, it's a lovely, wonderful movie. Well, that movie happened exactly during the market crash of 1929, which created a Great Depression. And some people say it was actually what really caused World War II. I don't know. But this was a very big market crash, which happened at a time, or happened because the markets were not properly regulated. For example, a person that became very, very wealthy was someone by the name Albert Wiggins. He was the CEO of the Manhattan Bank. And he knew that there was a lot of problems. He knew there was a run on the banks. He knew that his bank was going to die. So he shorted stocks of his own bank. Today, you do that, you go to jail. In 1928, you do that, he made $4 million of the time. He became very wealthy because there was no regulation stopping you from doing that. The regulation came after the crash, because when there's an accident, regulators go and investigate what happened here. How can we prevent this? And then the prevention came through the Investor Advisors Act of 1933 and the Exchange Act of 1934 that regulated how financial markets work, how stock markets work, and created the Securities and Exchange Commission, whose job is to ensure that the markets function correctly. And therefore, their job is to ensure that, for example, insider trading doesn't happen. But before 1933, you tell me what's going on with your company and I trade and I make money. Now, I cannot do that. So, the use of information is now, so whenever I say we use information, I'm always be saying we use legal information. I'm not going to break the law. But if you are a big investor and I know what you're going to do ahead of time, I trade ahead of you. If I know what the Korean housewives are doing or thinking, I do that ahead of you. What would be the analog today?
front of Trump?
Oh, Trump, my God. I think you can't. He's already done it.
I mean,
So that's my suspicion.
if you look at when he announced the tariffs and the one day later he stands with his friends in the Oval Office and is telling everyone how much money they made.
Exactly. Well, that's front running too, right? So, see, to front run Trump, I'm sure is very hard. Okay. But for example, what you can do and what some people are doing is you have a chatbot on Reddit, right? And then you know what people are talking about, and then you make investment decisions on the basis of that. Now, that's not in my lecture. This is not a trading style that I talk about because I have nothing to talk about. I don't have any data. I don't know what to tell you, but I know it's something that you can do. And I have it's not here, it's in a different course, but often I like to mention what happened with GameStop. It is a very good example of what I'm talking about. So GameStop, everybody's familiar with GameStop? You know GameStop, yes? Yes, okay, great. So let's go back to 2021. Let's go to January 15, 2021. What would we do if we want to benefit from the GameStop situation? We do exactly that. We put a chatbot on Wall Street Bets to trade GameStop as a function of what's happening there. You have time, because the time that lapses between the chatter and people trading is about a day. Especially for those people that were doing that, they were most of them teenagers. They say, I want to invest, they have to actually, it takes time for them to get their money and actually do the investment. A professional investor can invest in a second, they probably take time. So that's interesting. That's another thing that I'm not talking about, because that is a type of investing where your sources of data are not numbers. It's text. And of course, we can do that now. We have ChatGPT, we have large language models, we have a way to consume data and make decisions. But that's also not in my style. It's nowhere there to be found. And the reason is I don't have stories to tell you, but I don't have data. So there's very little I can do. So I want you to be aware of that. What I'm going to be talking about in this course is old, but it's something that you should know. Before you go to the modern investment activities, which for sure should require that you take textual information. Don't just get your data to be only numerical from Bloomberg. All right? Okay, so that's what I'm going to do. Now I don't feel bad talking about something which is like 20th century old. All right, so equity trading. There is two main ways to trade equities. Again, remember the footnote. I'm not talking about the avant-garde things which are happening now with chatbots, okay? Not talking about that. But these are the traditional ones: fundamental trading and growth trading. I'll start with fundamental. Fundamental is going to be the style that was developed exactly 100 years ago. And why was it done 100 years ago? Because the fundamental equity trading needs data, not chatbot data, but accounting data. What happened 100 years ago? The market crash. 1929, 26, 29, 100 years ago. And what did I tell you happened after the market crash? The regulators came in and fixed everything. One of the things they fixed is companies now need to report true data. Accounting standards were developed after that. That means that now companies report data which is good. Up until then, they reported data and you don't know if it's good. So making decisions on bad data is a bad idea. But making decisions on good data is a good idea. That's why fundamental trading has been around for 100 years. Because it was 100 years ago that data became reliable. History is very important. Pretend you understand how things happen. And then you can actually even predict what will happen, because now we're also in very historical times. So fundamental happened back then. Growth trading happened when? Make a guess. What is growth trading? I'm going to give you a lot of details about that, but growth is not like fundamental. Fundamental is, oh, this company is very cheap. Like you look at the financials, oh my God, I'm buying $1 for 50 cents, and you buy it. But growth, no, what is growth? Let me give you an example of growth. You know this company called Facebook? Yes? Do you know, or do you even, I don't know, I think you remember, but do you know that Facebook went and did its IPO a few years ago? Yes? Do you know the financials of this company called Facebook when they did, you know what the IPO is? Okay, when you go to the market, right? Do you know, do you remember the financials? Can you guess the financials of this company called Facebook? Did an IPO in excess of $1 billion? How much money?
I don't know, but my guess would be they weren't even profitable, probably low assets.
They had zero revenue. Someone from the 1950s look at what you're doing and say, what are you doing? You are paying $1 billion for a company that has no revenues? You're crazy. Why did investors do that? You know why they did that. They were not crazy. So it doesn't have revenues yet. That's why I need to buy it now. Because by the time it has revenues, forget it, I cannot buy it, right? You need to be in advance of what will happen. And that's growth. And that developed, of course, with the tech boom around the year 2000. So fundamental, 1930s, growth, 2000, right? Okay, now there's something in between that, which is GARP, that's growth at a reasonable price. It's somewhere in between, right? But I'm telling you. Now, momentum trading, what's momentum trading?
Yeah, reacting on specific movements. So, for example, if the stock is moving in upwards for the last, I don't know, couple of hours, a couple of minutes, or also maybe a couple of days, then I jump on the train and
Exactly.
in the same direction.
Exactly. So it's momentum trading means you buy on velocity. Oh, this stock is going up. I'm going to buy it. For how long? I don't know, until I see that stopping, and then I have to jump very quickly out of that train before it crashes. That's momentum trading. So there is a very well documented momentum trade in Netflix in 2013. You know Netflix, yes? In 2013, hardly anybody knew Netflix. I suspect in 2013 they still did CDs. You know, Netflix started their business with CDs, no streaming. There was no streaming when they started. And they had you know the story of Netflix? It's a fantastic story. Netflix competed against one company. The big video company before Netflix was a company called Blockbuster, American company. Most of their stores were in the United States. If you haven't been there, maybe you've never heard of them. But this company called Blockbuster was a very interesting company. They rented videotapes. There were no CDs. That's how they started. Videotapes, VHS. You know, there was a big cassette the size of this laptop, and that movie was there. You had to put it into something even bigger. Okay, and then that's how people watch movies. And then CDs came, and then, well, they did the same thing with CDs. And they had a very interesting strategy, which is that they liked to own every building they had. That's a strategy that they were not the only ones. Other companies do the same. There's a very famous story by Nobu, the restaurant. You know Nobu? Nobu? Have you heard of Nobu, the restaurant? Robert De Niro owns that. These are restaurant chains that they do that. They know that when they go and they open a restaurant, wherever they are, the building in particular becomes more valuable. So they buy the building and then they put the restaurant. They don't put the restaurant before they buy the building, because then they're giving the value of their brand to someone else. Okay? That's investing too. So Blockbuster did the same. They like to own the buildings where they were. With such bad luck that when 2008 happened, which was a big real estate disaster, they just died. There was this company that was doing something similar to Blockbuster, not streaming yet, CDs, but there was one differentiation between Blockbuster and Netflix. Well, first, Netflix sends you the CD by mail. You don't have to go to the store. Okay? A slight convenience, but there was something, which is that Netflix had no late fees. You just have to return your CD before you order the next one. It's a flat rate, like now, and then you can watch as many movies as you want, just one condition. Return the CD before you get the next one. Blockbuster didn't do that. They had late fees. And the late fees were substantial. 40% of their revenue came from late fees. And when Netflix was fighting them, one of the arguments that people say, well, maybe we should remove these late fees. Are you crazy? No, we're not going to do that, because 40% of my revenue is from late fees. And the thing is, that's 40% of your revenue now. You're going to have no revenue in 2 years, because Netflix is going to just wipe you out because of that. Precisely because of that. Of course, then streaming came, and then it became a variable company. So two things happened to Netflix. On the one hand, the fact that Blockbuster was gone because of their real estate mistake, and Netflix was eating up their space, and streaming was beginning to happen. So then investors just said, whoa, and then Netflix was the target of a very large momentum trade. Even the CEO acknowledged that it's a momentum trade. CEOs don't like to acknowledge that it's a momentum trade. When you go up. When you go down, yes, but when you go up, no. Say, oh, no, it's all about me. He said, no, it's a momentum. And yeah, you'll have the statement written there on the screen. So you can do that. Momentum trade is there's no fundamentals. There's no, you just say everybody's buying, I should buy it too. And then I have to be the first one to sell. That's the thing. There you have to be very fast to unwind it. Fundamental investors don't care. No, this company is good. I'll hold it as long as I can. Goes back to the idea why stocks happen. But now when you talk about momentum, this is not why stocks happen. So Facebook went IPO because they needed money. They didn't go IPO so people could start playing games with their stock valuation. So as you can see, the further down we go, the more that stock trading looks like a game. But I want to tell you, it's not a game. If you think that it looks like a game, then you're looking at the wrong thing. And then the last one is what's called technical trading. Technical trading is a very old style. Some people have beliefs, sometimes religious beliefs, that certain price levels give support to the stock. It's never going to go below this level. And then but if it crosses that level, it's going to drop another 10%. People have these magical formulas in their heads, sometimes on their computers, that tell them what to do. It's been around for a long time, and people have developed charts and rules of thumb, and they operate on the basis of that. You probably have heard of that. Well, the thing is that has now been revitalized, because what people were doing is now being replaced by other people who are using guessing algorithms, using neural networks, or who knows what, to do the same thing. It has been proved not to work, with one exception, which is that if everybody has the same rule, of course it works. It's called the self-fulfilling prophecy. if everybody thinks that, say, $100 is a good support level, when it crosses that, of course, everybody thinks the support level is gone, so it's going to drop and everybody sells. And then, of course, it sells. And of course, the price drops. You understand? So this is a social mechanism that makes a lot of these rules magically work. And that's because the whole community agrees that these are the rules that will dictate stock valuation. You understand what I'm saying? Yes.
And who started these technical analysis?
It's been around for a long time. I guess someone with a marker and a ruler for the first time, and then it developed. And I know some people that they believe in that, and they trade on that basis. I don't know when. It's old. It's been around for a long time.
Because I mean, at first it shouldn't have. No, they shouldn't be able to trade on that, right?
Except for one thing, which is the people who buy and sell stocks are, now everybody can do it, but up until recently, it was hard to buy and sell stocks. So these were reserved to very small communities that were in their own echo chambers, typically a restaurant in New York or something, and they talked to each other about this thing. And then there was this belief that these rules actually held true. That's what I imagine. I don't know, but this was a long time ago. I can tell you one thing. I mean, I've been in the investment business for a while, and it is, the investments have always, not now, but have always been the domain of very few individuals who talk to each other a lot, and they develop this echo chamber where they convince each other of what they're doing. It was very interesting, for example, for me to go to New York and talk to investors in New York, and go to San Francisco and talk to different investors who have lunch with different people, who talk about different things and have different opinions. But most of the investors are in New York, or were in New York. Now with a phone, you can invest from anywhere. And you can talk on Twitter with whoever you want and get information from who knows what. So this has become much more democratized. So that cottage industry that was stock buying is gone. And that's why I think today you should not invest without having textual information, without having a chatbot on Reddit, for example. Because your information is stale. Doesn't matter how good your company is. Doesn't matter how good your company is from the financials. It's going to be, if people decide to go against it for whatever the reason, then they will. And the pain could be substantial. So. But again, that's also not in this lecture, because I don't have data and because I just tell you that these are the things that are happening. So I will focus on the things which will always be there no matter how information is given to you, no matter whether information you get from Bloomberg or from Reddit. Many of the things I will talk about today will always be the same. So let me start with fundamental equity trading. A fundamental equity trader will look at a financial statement like that. Here I have 5 companies: Apple, Microsoft, Verizon, HP, and Google. And I got this, I mean, the numbers are very obsolete. It doesn't matter, they don't need to be current. And then they would look at these companies from a financial perspective. You look at the accounting statements, and the accounting statements will tell you certain things about these companies. You have the price to equity ratio, you have the earnings per share, you have the price to sales ratio, and this and that. These are accounting driven information, and you can get them on Bloomberg, for example. You can get them on Yahoo Finance, on Google Finance. This information you have access to, and a fundamental trader will look at this information and decide which company is attractive and which company is not attractive. Let's assume that we're not doing short selling, we're only going to go long only, we're doing a mutual fund. And I have these companies, and I said, which one should I buy? I have $100 million that came into my fund today, and I need to allocate it. I need to buy companies. Which one shall I buy? That's the decision you have to make. A fundamental analyst will look at that and say, okay, let me take a look. I look at Apple. Wow, very expensive, $147. The number is very old, okay? But then I look at the price to equity ratio and it's 17. Microsoft is much worse, it's 30. So from this perspective, Apple looks a lot cheaper than Microsoft, right? But HP looks even cheaper. But then you think, no, it's even cheaper, but yeah, they're probably not going anywhere. You know, so you make your prediction. In fact, if you look at the earnings per share, HP is making very little earnings per share, whereas Apple is making a lot of earnings per share. And then you look at the sales to price ratio. I said, you see, HP is very bad sales to price to sales ratio. And you take all of that information and then you make your decision. So your decision is based on the finances of the company. You want to buy good companies for a cheap price. And this happened around the year 1930. And the reason is that it was around that time that the information that companies gave you was guaranteed to be correct. Okay? So there are still people today that's what they do. And you look at sales numbers and this and that. So you're looking at that. Some of the quantities that they like to look at is price to book, the difference between the price of the company and the book value of the company. The book value of the company is the difference between the assets and the liabilities. That's essentially the money in the bank after they pay all their bills. And price to book is never one, by the way, never. One will be like too cheap. Okay, no one buys a company for the amount of money they have in the bank. The company needs to have some other things, right? And this is not just the price, this is not the cash in the bank, it's the asset value that you have, all the buildings you own and this and that. So a price to book of 5 is cheap. A price to book of 50 is expensive. But you look at that. Earnings per share, which is, the earnings is how much free, could be also free cash flows per share. How much money are you generating per share? If you generate a lot of earnings, that means your company is very profitable. I like it. If it generates very few earnings, then I don't like it and I don't invest. Net income. The difference between earnings and net income, you have to be an accountant to be able to tell. Free cash flow, similar things. You have to be an accountant to tell the difference between these things. So EBITDA, that's earnings before income tax and depreciation of assets. Another accounting variation of the same idea. How much cash are you generating every year? And fundamental investors like to invest in companies that generate a lot of profits. Oh, I made another $100 million this year after I paid all my expenses. Oh, your price is only, your price is only 2 times your book value. This is fantastic, I want to buy. And that's what they do. When you do that, you can be reasonably certain that this stock is you're not gonna lose a lot of money. So it is considered that the risk that you're taking when you do that is less because your purchase is backed by a solid asset value, which is the company that you're buying has good financials. And the financials are probably gonna stay there for a while. Understand? So this is considered to be the least risky of the methodologies to buy stocks. So I don't know if you buy stocks, but if you buy stocks, I mean, from where you stand, maybe this is a reasonable method for you to consider. Some things that I see sometimes, I see people say, well, I buy this company because the stock is so cheap. And then you ask, why is it so cheap? It's only $5. I mean, buying a car for $5 is cheap. But buying a company for $5, why is that cheap? What's your reference? You need to know what that $5 compares to what. And many people don't know that. Okay, now I'm going to the retail level. Okay, I'm trying to bridge what institutional investors do to how you might think about investing. So if this company has no cash flows, then $5 could be very expensive, right? Oh, but I like the products they do. Well, you may like the product, then buy the product, don't buy the stock. That's a very often, a common confusion that I see. And this is one of the reasons why companies that do goods that teenagers like to invest in those stocks, independent of the price. By the way, perhaps that's what happened with GameStop. They like to go to GameStop to buy their games, and I'm sure no one did any serious analysis about the value of GameStop, the company, before they went and bought the company because it was mentioned in Wall Street Bets. Yes.
Wasn't it about that hedge fund shorted?
Okay, so there was two things. So let me talk about GameStop a little bit. It is true there was a hedge fund that shorted it. That was true. But so what? Hedge funds short stocks all the time, right?
Yeah, that's true. But it was a popular company across a certain community that.
Correct. So let me tell you what I think. Okay, now I'll tell you. And again, I'm not an expert on GameStop. It's not something that I studied enough because first my students were asking me about that, and I was interviewed by some TV stations and stuff. So I had to educate myself. I was never particularly interested. I am interested in that as a social phenomenon, and I talk about that when I talk about the new way of investing. But so GameStop, do you know why the hedge fund was short GameStop? That's the interesting part. There was a hedge fund, Malvin Capital, I think it's on the website for the course. Malvin Capital was short GameStop, and they were short GameStop, I think, for one reason. GameStop had no internet business plan. They sell games on a disc. You go to the store, you buy it, you go home. There wasn't a business plan to sell on the internet. And the hedge fund said, well, a company in the gaming area without an internet business plan cannot survive. That was the thesis. Understand? Mm-hmm. That was the thesis. So what do? You short. It's a good trade. That's what you do. You should short. You look at the financials. They make this amount of money. The company is valued this much. No internet business plan. I short. All right, good. Now, what happened between the hedge fund going short, and I don't know who they talked to. I don't know if people knew. Typically, hedge funds don't tell anybody what they do. So I'm surprised that people knew what they were doing. How did they know? I don't know. But if someone knows what they are doing, then why do you even put up a fight? Why do you even go and trade the opposite of what the hedge fund is doing? There was a lot of bravado. There was a lot of, there was almost a generational movement that this hedge fund is run by these boomers. So boomers, you're going to find out who I am, right? And there was some of that too. So it's almost like warfare, which sometimes happens in financial markets. You just go after a company. Why not? In this case, they went to rescue a company. Why not? How that became a social wave, I don't know. Was there something else there? I don't know. Was it that consumers, the clients of GameStop, really liked the company so much that they went to rescue the company? Is that possible? It's possible, right? I mean, how many people are great clients of Apple who would do anything to rescue the company if it's in trouble? Maybe that happens. I don't know. I cannot. So there's a lot of things which I don't understand, but there's a lot of things that happen which are very unusual. A hedge fund trade becoming public, very unusual. Sometimes they have to Sometimes it's alerting me that I have to lecture, I think. So I said, no, I think it's... Sometimes hedge funds have to report. If they have big short positions, they have to report them. Was it that big that they had to report and then people found out? It's possible. I didn't look into these details enough. I wasn't interested enough. But the fact of the matter is that a social wave was created. And the social wave did not take anything like this into account. The short position did take this into account. But you can see, didn't matter. And it's a short position. We're going to see in a few minutes how short positions are far riskier than long positions. In a long position, well, actually I can tell you now, in a long position, the most you can lose is everything. In a short position, you can lose much more than everything. Short positions have unlimited liability. If the company goes up by 400%, you're going to lose 4 times what you invested if you're short, right? So very interesting. Actually, if any one of you wants to do a business case on GameStop, I would love it, because I haven't seen a proper business case on GameStop. That's a good idea. If you want to do it, go ahead. I'll help you. Yeah. Okay. Growth trading. I'm going to go through this quickly. I've been talking for a long time. So growth trading, they look at certain other different types of metrics. So for example, historical growth strength. They look at the growth rate you have had for the last 5 years. And there's some benchmarks that are considered to be good. If you're a very big company, if you've been growing at 5% rate for the last 5 years, this is great. You're a great growth company. If you're a medium-sized company and you've been growing at 7%, a little bit higher, then you're a good company. And if you're a tiny company and you've been growing at 12%, then you're a great company. So as you can see, the benchmark is higher the smaller the company. Big companies don't grow as fast as small companies. And then you can look at forward earnings growth, which means people have to make predictions for what your future growth will be. If you're Microsoft and you are now everybody's buying PCs and then you make projections. Well, if I think now 1% of the population has their personal computer, but I think we're going to go to 30%, right? Everybody now has a PC can be afforded by every family, so there's going to be 30% of the people will have their own PC. Oh my God, look at that. Then you make your projections and you're going to see, oh, this company is going to make a lot of money. There's nothing in the financials today that will substantiate that growth. Okay, what you have in the financials today is every time they sell something, what is their profit? So you have to extrapolate that. Or sometimes you have companies that are just going to become much more efficient. Case of Netflix. They had some expenses with postage stamps to send the CDs from here to there. But now if you do streaming, what are the costs of streaming? Vastly less. So that is a tremendous change that you will only see in the future. You will only see that change 5 years from now, but you know it's coming. So it makes you get into that trade with the conviction that the future will be very strong. And an example that is used here is Microsoft in the year 2003. So Microsoft went through its growing pains with Windows in 1995 and things that you probably never even heard. But around 2003, after they launched 2001, and people, that was when computers were beginning to be on everybody's desks. That's when people started to think, oh, I think I can have my own computer. People didn't think that before the year 2000. Most people didn't have computers. But when that happens, well, Microsoft was the big seller of that piece of software called Windows. And so how does that look? And then you make your projections. Very strong growth, historical growth. The projected earnings are fantastic. The revenue, the cost control and revenue are also very nice. And the return on equity is going to be far above the industry norm. So this is a great candidate for a growth trade. The idea is everybody will have their own computer, but the numbers are here. And then people do the analysis and say, you gotta buy Microsoft. Fundamental investors will not do that. Said Microsoft, no, it's too expensive already. But growth investors said, no, it's not expensive yet. Because look at all these numbers. The numbers would be far better in the future. You have to find a way to make those projections. Okay. And then you have GARP, somewhere in the middle, growth at a reasonable price. All right. Now I want to talk about equity short, but I think we'll take a break. Now I'll talk about shorting equities. The process of shorting equities is very involved. Technically speaking, shorting equities is the following. I cannot buy a negative amount of stocks. I cannot do that. What I can do is I can borrow stock from someone who is already a shareholder. I sell it, collect the cash, and undertake the obligation to give it back. Okay. When do I give it back? Do I give it back whenever I want, or whenever the owner wants me to give it back? You know the answer to that?
Yes, usually you have a contract, right? Like you define that, and then you have a specified date where you have to do it.
No. So these transactions, if I do a bilateral transaction with you, then maybe we have an agreement and say, well, I'm going to borrow your stock for a year and I'll give it back to you for a year. Typically, it's not like that. Typically, you don't have an agreement with me. You have an agreement with the broker who sells you the share, and the same broker who's going to short my stock. And according to that, the broker will lend me a stock. The stock is being lent to me, will sell it on my behalf, will give me the cash, but I can tell the broker when to unwind that short, and then they will do it, which means I give the cash, they buy the stock, and the stock goes back to their inventory. So you will never realize that this stock, which was yours, actually left the bank to give me money. Normally, you don't realize, normally. There are things that you can do. You can tell your broker, never lend my stock, and then they will never lend your stock. But then they will think you're a very bad customer, because that's how they make money. They make money by lending your stock, okay? And then they may charge you more for whatever service they're giving you. But normally, the broker will lend me the stock, will sell it, give me the cash, and then whenever I say, I'm done, get rid of it, they unwind the short, and everything goes back to the way it was. However, if the owner of the stock wants it back, wants to sell it, the broker will force me to buy it back, so I'll return it. Normally, this doesn't happen, because what the broker will do is, well, the owner wants the stock, they just switch the stock for another one. All stocks are the same, and they just switch it to another one, and then they give it back. They give some stock to the person who wants to sell it. The process of selling it doesn't matter which one you get, you're going to get the price. You're not a shareholder anymore, so they can swap the short that they have with me. The problem arises when there are no more shares in the inventory of the broker. And this is what's called a short squeeze. At that point, I will be forced to buy it back and return it, and there's nothing I can do. I have to do it. So the obligation, so I have an obligation to return it whenever the original owner wants it. Imagine I'm borrowing your car. It's very similar. You're not going to use the car. I borrow the car and I return it whenever I want. And I pay you for however many days I had the car on loan from you. But if at some point you say, I need my car, come back immediately, then wherever I am, I have to go back, return the car, give it to you, and then my car loan is finished. That's a good similarity, okay? That's how it works. So the process includes a number of steps. The first is you need to initiate what's called the locate process. You need to find someone who's willing to lend you the stock. Because that's the reason you go to a broker. Unless I know someone who has the stock and then I can do an agreement with you, typically you don't. You go to a broker, the broker knows thousands of people who own the stock. But they have to find one to give it to you. And then the stock is given to you on loan, but you have to pay a financing rate for that. It's a spread. Today I'm going to I assume a very big spread of 1%. Because I need to work with round numbers, but usually it's like 35 basis points or something like that. You have to pay for that. Then there's another rule, which is if I borrow stock, I cannot sell it immediately. I have to wait for what's called an uptick. The price of the stock has to go up a little bit before I can sell it. This was done to prevent a cascading effect where I can short sell and short sell and short sell stocks and then just bankrupt the company. You understand? This comes from the same regulation that I mentioned earlier, 1933. This is the regulation that was created to protect stock markets. It's called the uptick rule. Now, I have to say this uptick rule was removed in 2007 or 8 or something like that in North America. It still is alive in Japan, I think. I think in the Japan Stock Exchange you still have it. Yes?
Is there a reason why it was removed during the financial crisis?
Sorry?
It was removed during the financial crisis?
It was removed during the financial crisis, yes. I was shocked too. I don't know. It had nothing to do with the financial crisis.
Okay.
It had nothing to do with the financial crisis. This is a rule that gave me a lot of work when I created my first fund. Okay, this is a very, very difficult rule to exercise on certain occasions. But in Japan, it's still there, okay, as far as I know. And another aspect of short selling is that you have the possibility of a short squeeze. When all the stocks are recalled, and when all the stocks are sold, and you have a short position open, then yours will be closed. You have to buy it back and return. And typically, you have to buy it back when it's very expensive. So if you're a short seller, you have to buy it when it's expensive. Typically, you lose a lot of money on that. So a short recall is a big deal. It's a very big deal. There are companies that's all they do. They spend their day shorting stocks. I'll give you an example. And this could be interesting for you. I know of a hedge fund. It's 3 people in New York City, lawyers. They go to work. I don't know what time they go to work. They go to work. But what they do at work, I don't think they need to go very early, because what they do at work is they just read documents produced by the SEC. The SEC is the regulator. Or imagine in Germany, you go to work and you read documents produced by BaFin. That's all they do. And in those documents, they say, oh, this company is in trouble. You short. Next document. Oh, that company is in trouble. You short. You understand what I'm saying? Looks like a good business, no? Just see which company's in trouble and you short. And then say, well, I'll short for 2 days. I short for a day. Oh, I short for a month. Right? Now, that's interesting because these were 3 lawyers reading SEC documents. You can have a computer do that now. Imagine a computer that just goes, and all of these things are public, they are disclosed, they're legal documents. Just have a computer, go through all of them, and decide which company is in trouble. In fact, if you're bored one day, I encourage you to do it. Get these documents, put them through a large language model, and get a cell signal. You only get cell signals, you don't get byte signals. Get a cell signal. And if you have a broker that is willing to accept orders from your computer, just do it. Understand what I'm saying? Then you become a short seller. Now, let's be careful. Let's be careful, okay? If I short stock, then I get cash until I have to buy it back and return it. So it is very similar to buying a negative amount of stock, very similar, okay? But there are differences, because if for whatever reason the lender calls the loan, then we have to return it, and you have to deal with a broker, as we mentioned earlier. And if the broker runs out of stock, then you get called, and then you have to return it at whichever price is there, okay? I said here the most famous short squeeze happened with Volkswagen in 2008. Perhaps, for me, it's the most famous, but who knows, maybe not for you. But let me tell you what happened with Volkswagen in 2008. It's a very good example, a very good business case. This is not a business case discussion, it's just an example of what happened. But I want you to understand it, because it's related to something else that I mentioned to you on the first day, on Monday afternoon. And the reason why when I was teaching this course here in the years 2009 and 10 and 11, I had to ask everybody to remove the Volkswagen stock from the database. Otherwise, the eigenvalues that you calculate are completely off. But there's a lot to learn from 2008, from this story. And what I want to tell you is part are facts and parts are fiction. And I am still hoping someone could help me do the business case of Volkswagen. You will see why. I don't know how much you know about the history of Volkswagen, because this story I'm telling you, which happened in 2008, actually goes back to before World War II, goes back to the 1920s with Ferdinand Porsche. I guess you know that part of the story. Ferdinand Porsche was a very famous German industrialist. He had a business to create tractors and agricultural machinery. I have the hypothesis that he probably supplied military equipment to the German army. I don't know. I would love to know. Because that explains a few things that happened after. So I don't know that. Okay, I would like to know. But in the 20s, he created Porsche, the car company, named after him. And then during the Hitler government, the automobile division of Porsche was taken over by the government to create Volkswagen. And I'm told that he made his children swear on his deathbed that the family will not stop until he gets Volkswagen back into Porsche. I would like to know how much of this is true. I've asked ChatGPT and it's not clear. So if anybody, you probably need to speak German to get into the files. But it could be a fantastic story, because what happened is this. In 2008, this is in the middle of the crisis, every hedge fund was short automakers. during a recession, car makers suffer. No one buys a car. This is a shocking number. In 2008, if you look at the car sales that happened, there's a way to go from car sales to how long will people keep their cars given that they sell cars at this rate. Understand what I'm saying? Right? There's, I don't know how many millions of people with cars, and I'm selling these thousands of cars, so everybody will keep their car for 27 years. That was the numbers implied by the car sales in 2008. Do you know anybody who drives a 27-year-old car who is not living in Cuba? Do you know anybody? No, I don't know anybody who drives a 27-year-old car. Well, these were the sales numbers in 2008. Hedge funds were all short cars. There was a very interesting situation actually in 2008. There were two car companies, Volvo and Renault, the French company. In 2008, Renault owned 100% of Volvo. Volvo was valued higher than Renault. And by that I mean, if you take Renault and remove all of its debt, and Volvo remove all of its debt, the net value was actually less, despite the fact that Volvo was 100% owned by Renault. What that goes to say is that the market was not only in a deep crisis, it was completely irrational. That was 2008. It was a crazy year. There were so many crazy things going on. This was crazy, right? All right. The thing is, because of that, this is my suspicion now, Porsche saw the opportunity to finally get Volkswagen back into the family, as Ferdinand Porsche had asked its family to do. You understand? This could be a wonderful movie, by the way, if you write the proper script, right? All right. So on October 24th, 2008, the ownership of Volkswagen was Porsche, 42.6%. I can't pronounce that in German, but the state of Lower Saxony, you know that, is they own 20.1%. And 13% of the stock of Volkswagen was on loan for shorts. 13%. That leaves a float of about 25%. When you short stock, you always look for the float. And you need the float to be several orders of magnitude bigger than the daily volume. Footnote: I don't believe some of the stories that go around concerning GameStop, because I've read that Malvin Capital was short more than the number of stocks issued by GameStop. Maybe, but that's dumb. I've never seen that. Not only you don't short more than the number of stocks that exist, you actually always look for that float. And the float has to be healthy. If the daily volume of stocks is 5% and the float is 25%, that means that you typically have 5 days to get out if there's a problem. You understand what I'm saying? Right? But if the daily volume is 50% of the company is traded every day, it's crazy to go short when the float is only 25. Because that means you're going to have less than a day to unwind your short. Very risky. You see that? That's another source of risk. The relationship between the float and the daily trading volume. You understand what I'm saying? Understand? Okay. That number, 25%, you have to look at that in the context. Well, first of all, if that number is negative, very risky. that means that you're going to be called on your short like anytime, right? But if that number is, say, comparable to the daily volume, let's say that the daily volume of the stock is 20%, and the float available is 25, that means that there's a very high probability that you will be called on your short. Oh, by the way, you never want to be called on your short, okay? It's a guaranteed of that you die, almost. Because you never get called on your short when you're short, you want things to be bad. You're never called on your short when things are bad. You always call your short when things are good. You're going to lose money, right? You can't say, wait, wait one more day. No, you can't wait. You have to unwind your short like right now. So that's why if the daily volume is comparable to the float, that's very risky. That means that the probability you get called today, tomorrow, on a given day is very high. You don't like that. That's what I'm saying. Yes?
Can this float rate be negative? And what does it mean?
The float be negative. The ambulance is coming for you in a matter of minutes. It could be, but it's like I've never seen that. By the way, in the case of Malvin Capital and GameStop, they say that it was negative. They say that Malvin Capital was short more than the. I don't know. I haven't been able to check. I've never seen that. Never seen that. I've dealt with dozens, not hundreds, dozens of managers, and they always look at the short. If the short, sorry, at the float. If the float becomes small, like by small I mean if the float is only a few orders of magnitude bigger than the daily volume, you get out.
I don't think I really understood it correctly. Why is it bad if the daily value is higher? Because I would understand it in a way, then the market is more liquid and I would get out more quickly.
Oh no, yes, the market is liquid, but if it's liquid against you, the float has to be if there are a lot of trades in your stock and you're short, you have to assume that these trades could be against you. They could be in your favor, but they could be against you. If everybody's selling with big volumes and the float is very small, then the probability you get called on your short is very high. You want the float to be big. Sorry?
What does float mean?
Float. Float is the amount of shares which circulate, which have not been encumbered as shorts. Okay, so here what we have is, you can see 42.6 plus 20.1 is about 62 point something, right? The rest of those shares are free. They don't belong to Porsche, they don't belong to Lower Saxony, which means people can buy and sell them. You assume that Porsche and Lower Saxony are not going to sell their shares. You're going to, they just hold them like forever, right? So the rest are the shares which are traded. 25%, I don't know the daily volume of Volkswagen at that time, but I assume, 25% is a huge number. No company trades 25% of its shares on a given day. It's just crazy, right? So maybe it was 1%, maybe it was 5%, something like that. Which means 25% is, if the market moves against you, that gives you 5 days until all that float runs out, because everybody wants to sell their shares. So 25% is a very healthy buffer when you're doing shorts. And people who short look at that number. And if that number is small, you don't do your short. In fact, if you are short, you unwind your short because it's risky. They can call you and say, I don't know, think about it this way. Imagine that we're renting a car with a clause that says, oh, if we run out of cars, you have to return it like right now. If I'm in Berlin and you have to return Munich, no, you have to like right now, like from Berlin to Munich in half an hour. Like you need it now. You see? Then you look at how many cars are there. Well, there's a lot of cars. And the clause says that if my car is needed, they can take another car. So there's a lot of cars out there, 25%. Nope, they're not going to call me. There's another car, get another car. They're all the same. But if the float gets very small, and this company rents a lot of cars on a given day, so the probability that in my car is very high. You don't want to be there. That's the float. Yes? Yes? So this it was very healthy, it was a good situation. What people did not know is there was an announcement on Sunday, October 26th. An announcement by the CIO of Porsche, who said, ladies and gentlemen, we have been building a position. We have been buying cash settled options on Volkswagen over the last months, years, equal to 31.5% of the stock. We've been after Volkswagen company for almost 100 years. We finally got it. Understand? That was the announcement made by the Chief Investment Officer of Porsche on October 26th, Sunday. What does that mean? The float is negative. You don't know when these cash settled options, I don't know if he said it, when these cash settled options would mature, which means you don't know when these will have to be given to Porsche. But whenever it is, the stocks will run out. I don't know if it is known. I know the bank who was the broker, but I don't know if I can tell. So I'm not going to tell you, but if someone can find out the name of that bank, I would be very happy, because that means it's public information. And finally, going forward, I can say the name of the bank. So if any one of you can, I asked ChatGPT, couldn't find out. So if any one of you can find out the name of the bank, please let me know. I would be very grateful. So then I can say not only the name of the bank, but also what happened to this bank after this, which I cannot say. Okay? It's a good, I think this is a better story than, no, it's a different story from GameStop. It's another very interesting, okay, what happened then? This was Sunday. By the way, we were there. We were not a lot of money, but we had about, in my fund, about $100,000 or $200,000 in shorts on Volkswagen. And we talked to the manager on Sunday, and everybody was doing the same thing. On Sunday, you're looking to unwind as much as you can. On Sunday, markets are closed. The first market to open is the one in Tel Aviv, Sunday night. And people were just trying to find someone who was willing to sell them shares, because you know it's going to be a very bad Monday for those who are short. It's going to be a wonderful Monday for those who are long. And you understand what's cooking here on Sunday? So that Sunday I spent a couple hours on the phone trying to understand what was going on. So I lived through this myself. Okay? So on Monday the 27th, Volkswagen opened on the rise. So now something very interesting happens, right? So why does it open on the rise? Why does it open going up? Oh, so around this time, I think it was after, is when there was a rumor that a GM was going bankrupt, General Motors. They happened more or less at the same time. So there was a saying in Wall Street that the economy of the United States will be fine as long as General Motors is doing fine. That was a saying. And now the rumor was that General Motors was going to go bankrupt. By the way, it did go bankrupt. It went bankrupt. General Motors and Chrysler went bankrupt. Ford managed to escape. So the market was very anxious. It was very scared. So why do you think the market went up at the open?
Maybe because it expected that everyone will try to sell or to buy back the.
Everybody who was short needed to buy the shares back, right? So you had 13% of the stocks, there was a lineup of, I don't know how many shares Volkswagen has, millions. So 30% of that were lining up to buy shares to unwind those shorts, right? Okay, so that's when it went up. Short sellers were the first ones that wanted to buy. Yeah, we were there too. We're trying to buy, right? But then what happens? This is 2008, and here's a stock that is going up. All the others are going down. So what happens if you're not a short seller, you're a stock owner? What happens?
You want to invest in this stock. You want to invest in
No, you don't want to invest. You've lost so much money this year already. You want to sell. The stock goes up by 100%. You're an owner of the stock. What do? You want to sell. Finally, one stock is going up this year. It was a very bad year. I don't know if you know how bad it was. Very bad, very bad. Suddenly, one stock is going up. You want to sell. So you call your broker and say, I want to sell. They said, okay. Owner wants to sell. I have to call the people who have the stock on loan and said, you have to return it to them because they're all gone, right? So then the short sellers need to, even if you didn't want to, now you have to. Everybody was rushed into buying at first. Even if you want to sell, your sell order generates a buy order. So there's usually the market has an offsetting mechanism. People want to buy, people want to sell, and then you have tension pushing the price up and down. But here the price pressure is only to go up, because even if you want to sell, someone will have to buy before you sell. You see? So the stock went up even more. So if you were an owner and you had any doubts, you said, no, now I really got to sell. So the stock went up by almost 3 times in just a few hours. And that's why, by the way, when I teach this course here, I had to ask everybody to remove Volkswagen stock from the statistics of your first day, because such a big change destroys the eigenvalue that you did. We talked about outliers yesterday, remember? That's a very big outlier, and it destroys the mathematical structure of the German stock market. So short selling is, yes.
about the bank. DeepSeek and ChatGPT says it was Merrill Lynch, now the division of Bank of America. That's what everybody thinks. The real bank also starts with an M. That's why they think it's Merrill Lynch, but it wasn't Merrill Lynch. Okay.
Yeah. So, yes, people think it was Merrill Lynch. They know the first letter is M. Yes, it's not Merrill. I would love to be able to. It's a great story. Wow, great story.
It's still non-public information. So still non-public information.
I think it's still non-public information. Yes. If at some point it's public, you let me know. Okay.
All right. So now, short selling is risky for another reason. You already know that short selling can give rise to unlimited liabilities, because if you own a stock and the stock goes bankrupt tomorrow, you lose 100%. But if you take a short position and the stock goes up like 300%, then you lose 300%. Okay, so your losses are unlimited. By the way, the short interest ratio is the ratio between the short interest and the average daily volume. I told you that earlier, right? So you monitor that. You want that number to be low. If the number is high, you have a big risk. Okay. There's another reason why short selling is risky, which is companies oftentimes are taken over. I'll give you an example. Have you heard of this company called Nokia? Oh, you still remember Nokia? Huh? You know it. You know Nokia. Okay. So Nokia was a great company, essentially until smartphones arrived. BlackBerry first and iPhone later. Right? Because then who needs a phone, which is not a smartphone? And that's what Nokia was. And the stock was going down, down, down. And then you would say, well, I'm going to short Nokia. And you short Nokia. Then one day, Microsoft makes an announcement and says, we missed the market for operating systems for smartphones. Microsoft has never understood the internet. And I think today they still do not understand the internet. That's the big problem of Microsoft, okay? And they never understood mobile devices. So they missed the market for operating systems for mobile devices. The one company who did it right was Apple, and then Google copied them and created Android. And Microsoft was left out of the game. And then at some point they thought, I think we can fix that. But we need a phone company to test our operating system. So you know what? I'm going to buy Nokia. Great company, great brand, very bad product. And cheap. When that happened, when that rumor, they never did, but when that rumor happened, the price of Nokia went up by, I forgot, 300%. Everybody wanted to front-run Microsoft in the purchase of Nokia, right? What happens if you're short? You lose 300% in a day. And this is not an extreme situation. Like, no, it's just a company making an announcement of something that will not happen. It doesn't matter. You lose 300% in one day, right? So short selling has a lot of risks associated with that, apart from everything that we've discussed here. Still, there are people who they are considered to be short selling gurus. They specialize only in bad company. Steve Cohen, for example. These are people who are specialists in knowing which companies to short. But most people, they're bad at shorting. It's very hard to short properly. It's very good. There's a lot of good investors. Warren Buffett, I'll give you a long list of people who are good investors. But short sellers, there's a few names, but they've all been burned at some point, right? It's just difficult to short it. But what it is not so hard is to do both at the same time. And that's what I want to talk about next. Equity, long and short. Yes?
There's a banks heavily, either JP Morgan or Maple Bank.
It was not JP Morgan.
The Maple Bank.
Maple Bank. Where did you find that?
I asked in Chinese and they gave me.
Okay, there you go. Okay.
You need to learn Chinese.
Yes. It was Maple Bank. Yes.
Then it's public information.
Yes. Can you send me that link?
Yeah.
Can you send me where you got it?
Yeah. ChatGPT.
ChatGPT, but send me. If see if there is a source.
Yeah.
Finally, this is it's a Canadian. It's a Canadian bank. That's how I know. Send me the link, okay? Of the source, not the ChatGPT statement. The link of the source.
Yes. Then I can tell you. Then I can finish the story because it's a great movie. A few months after that, Maple Bank was raided by the German tax regulator, accused of certain things, which are probably not true, but it doesn't matter. The bank died immediately, right? If the German tax regulator just starts an investigation against the bank is finished. Whether it's true or not, it doesn't matter. As a bank, you need the trust of the people around you, right?
What do you mean? It's Canadian bank and it's German.
No, well, it was a German bank. There was a subsidiary of a Canadian bank. There's a Canadian bank that came to Germany. And maybe JP Morgan was involved too, but Maple Bank. And Maple Bank is still under investigation. You know, who knows, maybe in 5 years or in 10 years, in 20 years, they say, oh no, there was nothing wrong. But the bank didn't. You cannot survive an investigation by the German tax authorities. No bank can survive that. That's a way in which you can just, the German tax regulators can kill any bank tomorrow for no reason. No due process, just, we're going to investigate this bank. I think there's something wrong there. And that happened to them. They had to shut down. All the lines of credit were dried up. No one wants to lend them money, right? Why would you? Very high risk. That's not trading, that's lending, but then and the bank died. And I know why that happened. Very likely it was a false rumor, very likely, but it doesn't matter anymore because the bank just ceased to exist. Now the question is, who did it and why? And as you know, the story between Porsche and Volkswagen is very deep and contentious, and maybe I should remove this from the video. But this is, you make some enemies when that happens. That year, 2008, Porsche made $1 billion on that trade. Went up by 300%, and they were the biggest owner. They made far more money on that trade than making cars in 2008, right? And who owns who today?
Volkswagen owns Porsche.
There you go. Volkswagen owns Porsche today. Yeah. That part I don't know. I would love to know what happened there. So if any one of you is interested, write that business case. I will help you. Make that chapter number 3 of your assignment. And actually, you don't care about the other chapters. This would be wonderful. No, really, this is, by the way, let me tell you one thing. This is how you learn. Because this is the real world. I told you how to be street smart. You need to understand how these things happen. You have to know. That's what you should know. Yeah. Payback time. You understand what I'm saying, right? These are trades in the billions, not trades in the thousands of euros. That's not interesting. Trades in the billions. Huh? Good. Thank you. I should have. So that was, but not ChatGPT in Chinese.
Yes.
Really?
Yeah.
How come in English you didn't do it?
Well, maybe
No.
most programmers are Chinese.
No, because this is that's not how I expect large language models to work. They tend to be language agnostic, right? They translate your prompt and then they use a computer language which is not our language. They have their own. Interesting. Maybe I'll ask DeepSeek, see what it says.
DeepSeek's JP Morgan, ChatGPT said Maple Bank.
Oh, you checked? Okay, so Maple Bank is also in DeepSeek.
No, Maple Bank is not in.
It's not in DeepSeek, it's only in ChatGPT. Interesting. No, this poses questions about large language models, how they work. Interesting, very interesting. Okay, so This is very interesting, by the way. If anybody wants to get into that, let me know. Okay, I would love that. This is chance you become very famous. I don't think this story has been written. I don't know if anybody will write it. Maybe you should not write it while you're in Germany. I don't know. Maybe, we can write it from Canada. If anybody wants to leave Germany, maybe the Germans should not be writing this. Maybe it's us guys. We are the non-Germans here, right? Yeah. Yes, you don't want to be audited by the German tax authorities just because you write a story about Volkswagen. Eh? No, that's how things work. That's the way it is. That's the way it is. Yeah. Okay, great. So let's put it all together now. We've looked at how to buy stocks. We've looked at how to short stocks. Now I want to put it all together. By the way, I'm going extremely slow. All these stories, they delay me. I love it. I have to say, I don't know about you, but this is. I love it because I do this with hope that you get to understand all these things, and then everything else that you can put it into this context. So, okay, I'll continue. So when you put all these things together, then suddenly things become very interesting. Very interesting. I have here for you a long-short equity portfolio. What you see there on the left is the ticker symbol of the companies that were in this portfolio. Some of these companies don't exist anymore. I did this portfolio many years ago. But it doesn't matter. You will understand. You will get the gist of it. So I have some companies, and then I say I have the number of shares in my portfolio, and I distinguish between those which are long and short. So all the, so for example, when I look at Google appears as 100 shares, but I'm short. And here what I have is these are 100,000 negative. I don't say long or short because they are in this. Don't worry about how these things are stated. Let's just look at that. And this is a portfolio that contains, I don't know how many, 25 stocks, of which most of them are long. It's easier to look at the right column where they tell you the value of them. One is a short, and it's what's called a single name short, and that's Google. I'm short Google 100 shares. Which means, again, when I did that, it's a short of $73,000, short. And then I have an index short, which is the S&P 500, which is $14 million. And then I have a sector short, which is the QQQ, which is the NASDAQ ETF. So I'm short technology stocks at a rate of $788,000, about $1 million. Okay, let's look at this portfolio. And let's understand it. To understand this portfolio, you don't look at, Apple, 693,000 shares. That doesn't give you any information. What you have to look at there is, I have about 25 stocks. I have about $15 million on the long side, and about $15 million on the short side. Yes? I mean, I didn't add all the numbers, but it's about 15 million. So let's say 15 million long, 15 million short. The interesting part for us now is on the short side, because on the short side, I have only 3. First, I have Google. It's the smallest position in the portfolio. We know why. It's not that this manager is particularly bearish on Google, is that a short is very risky, right? So it's about 10 times smaller than the typical long. If that was much bigger than that, this guy's crazy. You're not crazy going long Apple $700,000, but it's crazy to go short Google $700,000 because the risk is much higher. And I'm adopting a lens of risk only. I'm not saying it's a good idea or a bad idea. It's just too big, too much risk. All right.
But then you can say, wait, the S&P 500, $14 million, that's even bigger. That's like bigger than anything. Why I don't care? Why I don't care? Because it's the whole market. The S&P 500 is not going to be taken over and go up by 300%. There's going to be no short squeeze on the S&P 500. I don't have Porsche buying, announcing they have options for 30% of the US economy, right? The S&P index short is not subject to a short squeeze. It's not subject to a takeover. It's not subject to all of the risks that we have talked about because it's an index, it's not a stock. A stock is different from an index. They look the same, but a stock is different. A stock has shareholders and has owners and has the companies being sued, something said about the SEC and this and that. This is companies. A stock is different. It's not a company. It's not subject to all the risks that we talk about shorts for stocks.
How do you short such an index? Do you buy a fund to kind of
No.
replicate it, or
Okay, so you can short that in two ways. One is the one which is not here. You can buy negative amount of futures. Everything I said about stocks is what I said is true. If you go to futures, things are different because futures are not securities. Futures, this is coming later but I'm going so slow that maybe I won't get there. Futures are not securities. They're not governed by the Securities and Exchange Commission. They are governed by the CFTC, the commodity, I forgot now. Sorry, it's written on the slide 57. Okay, they are different. And those are, when you buy a futures contract, a contract is not a security, so it's governed differently. You can buy positive amounts, negative amounts. There's no short squeeze. You don't get called on your shorts when they're futures. The exchange will make sure that your short can be there forever and ever and ever if you decide to keep your short forever and ever and ever. Okay? If the underlying of your future, which is short, goes up by 3% or by 300%, what the exchange will do is they will ask you for margin, as we discussed here yesterday, right? You just put up margin, say 5% of the value. So if the underlying future goes up by 300%, sorry, buddy, you're going to lose money when you buy it back. But for now, you only have to put up 5% of the 300%, which is 15%. Just your margin goes up by 15%. That's it, right? And if you're doing that in this context, you don't care that you lose a lot of money on your S&P futures because that was just a hedge against the rest of the portfolio. So your portfolio will go up by 15%, probably more, in which case it's not a problem. You have more than enough money to pay back your losses on the broad index. So that's one way. This is not the one. The other one is as follows. This is an SPY. SPY is an ETF, is an exchange traded fund. And I think that's what you were asking, right? Mm-hmm. So an exchange traded fund, it trades on the exchange like a stock. It is not a stock. It is a security though. It is a security. So it's managed like a security. So, but it doesn't have a company behind it. There's no issue with Porsche, there's no issue with GameStop, there's none of those issues. It's just a security that represents a group of 500 companies. So it's considered to be safe. But the locate process is the same. And the uptick, if it was to apply, would be the same. Yes?
But can't there then still be a short squeeze?
Yeah. Okay, it could. Okay, so I'll tell you another story now. This is another story, a story number. To have a short squeeze on the S&P 500, remember what it was? It was the short interest divided by the volume. The volume in the S&P 500 is billions and billions and billions per day, right? So it's very, very difficult to have a short squeeze on that.
So the answer is, in principle, it's possible, but it's very, I think, it has such big volumes, it's very unlikely, right? Sorry, by volume, sorry, there's volume and there's the overall. So the short interest is very small, very small. The float is very, very small. So it's unlikely it's going to get short squeeze. However, I was here on a Thursday teaching this course in 2009, and I had a live portfolio. I mean, I was teaching here at 3:30 p.m. I would have to always take a break during class because I had to, for 5 minutes or so, connect to my office in Toronto to monitor the market opening. I had to do it every day. That's how I taught, right? And then after 10 minutes, I always had a break at 3:30. Okay, so that day, everything was fine at 3:30, 9:30 the open. But there's another case that I'll be talking to you about. Yes, I will. I don't know when, but I have to tell you this. That was the Citibank convertible trade, and which actually happened while I was in Munich. And I'll tell you the full story, but Citibank had a short squeeze. And the short squeeze was so bad and so special that the short squeeze moved over, not to the S&P 500, but to the sector index, which is the financial subsector, which is the XLF, which is the ETF for the S&P 500 financials index. So bad. 2008 was like the year where amazing things happened. So the answer is no. It's like extremely unlikely.
Okay, so you look at the float of the whole S&P 500 and not of that particular ETF, right?
No. The ETF. The ETF will have a short interest, which is very small.
Okay, so if you would, for example, pick a very small ETF with very small...
Oh, then they can, no, yes, then it can be squeezed. Yes, that's right. If you pick a very small ETF, yes.
Okay.
Yes, that's right. Yes, with a big volume and big short interest or something, then, or even a small volume, it doesn't matter. You're going to be in trouble. Yes,
Okay.
yes. So the fact that it's so massive that a short squeeze on the S&P 500 is very, very difficult. Mm. But it could happen. It's a security, and even if you say, well, you know what, I'm going to buy futures to offset that. Because you can't buy, the S&P is too expensive. Well, buying futures is not going to help you because you have to return the ETF, not the futures. Okay, so yes. No. Don't apologize. I told you this is the way you have to act when you're in my class, right? That's how you. Yes.
I'm just really interested in what the overall idea behind this trade is. Is it the idea that you want to finance your long portfolio by the short positions?
Okay, I'm coming to that. Your question is perfect because what I'll be talking about for the next half hour is exactly that. Okay, so let's look at that and let's ask ourselves that question. What is this manager thinking of? What the manager is thinking of, it should be clear by now, is there are a number of companies that I think are great. I've done the financials, I've done the growth analysis, whatever it is that my thesis is, whatever it is that I analyze, free cash flows, you name it. These are the companies which are the best companies I can invest in, right? With one exception. Google, way overvalued. I hate it, right? All right, that's what I would like to have. This is the portfolio I would like to have. But then, I don't know the year, but say, I don't know that the market is going to go up or down. What I know, and I firmly believe, and I've done my analysis, and I'm convinced that this portfolio will do better than the market. The market could go up or down, and, you know, the US could do something stupid in some country, and then... So how do I protect myself against that risk? That's why I go short.
And we're going to see the thesis behind that, because I'm going to analyze this now. We're going to take half an hour to analyze that. Half an hour, okay? And in preparation for that, let me ask you another question, which is related to your question. How much money do you need to buy this portfolio? Let's simplify. 15 million on the long side, 15 million on the short side. How much money do you need? How much?
Nothing.
Nothing. Okay, so Sophia says nothing. Thank you for that. Okay, yes. How much money do you think?
I would say a little bit on the loan of the shorts, right?
A little bit of the loan. So give me a number.
Say, I don't know.
Give me a number. Everybody think of a number. Okay, how much you think this portfolio, not the value will be zero. Yes, I know that. But how much money you need to invest this portfolio? Sophia can go to Deutsche Bank now and say, give me that portfolio. I'll put it on. I need no money. Just thank you. I'm done, right? That's what you think you can do. Yes, that's what you said. Say yes. That's what you said. Yes. Now you're thinking maybe I need a few, 5 euros?
No, let's say like 500,000.
500,000. Okay, so you think you need 500,000 euros to get this portfolio when you talk to your broker and said, I want exactly that. Someone told me this is the killer portfolio. How much? 500,000, right? Good. Okay, so 500,000. Sorry, Jan, Sophia, Leon, yes, and you're sitting in the same place. You're Jonathan, but you moved, so you're not Jonathan anymore. Okay, yes, Leon, yes, okay, Leon, yes.
I would say additionally to Jan, we need a margin account.
You need a, yes, exactly. How much in the margin account? Yes, how much?
2 million.
2 million. So 0, 500,000, 2 million, 100,000, 15 million. I was sure you were going to say that. I don't know why. I thought you were going to say that. 15 million. I'll tell you why. Jonathan, how much? 2.5 million and Ole, right? No. Did you move? When you move, I forgot. What's your name? Ole. Yeah, okay.
10 million.
10 million. So I have, okay, so very nice. Good. All right. Good. I cannot say who's right and who's wrong. As with good things in life, there's no right or wrong. Okay. In fact, I think with your answers, I want to now do a bit of an analysis as to who you are. Okay? And allow me to do the following thing. So I'm going to take that question, I'm going to put it in a different context. Don't forget your answer, by the way. Okay? Don't forget your answer. I'm going to come to that. And this is the most, not the most, no. This is an important thing we need to learn today. So to understand that, I'm going to pick a very simple situation. By the way, I know I'm not going to finish by noon. I know that for sure. Okay, so I don't know if I think I finish this and then we take a break and then after lunch and then I see what I do. Okay? All right. So imagine you have so I'm going to turn the problem around. You have now $1,000. Everybody has $1,000. And we're going to do a trade. Only 2 stocks. One long, one short, to make it easy. Market neutral, so 0 net. Stock A is $100. Stock B is worth $100. And we've done the analysis and we like A, we hate B. And I'm going to buy 9 because I'm still not sure. Right? So even the most conservative answer, which is Eugene's answer, which is 15 million, I can still do that. The way you were thinking, I can still do that, right? Because the way you were thinking is that, well, I probably need $900 for that, right? That's what you were thinking. Sophia, of course, can do this. Like, I can do millions and millions and millions, right? Right? So that works. All of your answers will be consistent with what I'm saying here, the sizing of this. Yes? So I can do that. Good. So let's agree. Let's agree on the fundamentals. I have $1,000. Great stock A, bad stock B. Right? and I buy 9 of each, which costs me nothing. But I don't know. Somehow I suspect that nothing is not. So what I want to do is, and again, how I pick this, it doesn't matter. So let's say that I'm right. After a year, A goes up by 10% and B goes up by 5%. Why do I say I'm right? Because that was my bet, that A was better than B. My bet was not that A was going to go up and B was going to go down, and that's why I was short. No. No one thinks like that. Typically, your shorts are a hedge to your longs or vice versa. Why? Because we've learned on Monday afternoon that they all share the same risk, which is index risk. And you cannot get out of that, right? You can be super smart and figure out that A will go up and B will go down. I've never seen that. Because both are subject to the fluctuations of the market, which no one can predict. You understand what? This is very important. We never know what is going to go up or what's going to go down. There's hope we know what's going to go up more than the average, or what's going to go down more than the average. That we can know. But no one can tell you what's going to go up and down. All right? Okay. So let me do the financials of that. And I'm going to start with the conservative trade. That will be the Yuqin trade. Did I say your name correctly? Yuqin? Yuqin. Okay. So it's similar to what you said. Not exactly the same. All it was doing something similar. So that'll be your trade, right? So I said, okay, I'm very conservative. $1,000 in cash will be $1,000 in a year. 0 interest rates to simplify the calculation. We don't want interest rates right now. They don't change anything. So let's say 0. So my cash today is $1,000. My cash tomorrow in a year will be $1,000. Yes? My 9 long A's today are $900. In a year, they will be $990 because it goes up by 10%. We're good? My short B's today are $900 negative. In a year, they will be $945 negative. Because I lose 5% on those. Right? Short selling fees. I have to borrow. The interest rates are 0. But I can still not borrow for free. I mentioned earlier that I have to pay some financing in addition to the interest rates, which is usually 30, 35 basis points. Sometimes it's a lot more, I'll tell you. But in this case, I want to say, for simplicity, 1%. So I have to pay $9. Despite the fact that interest rates are 0, I have to pay 1%. So I have to pay $9 to the bank for the shorts. Does the bank keep it? Does the bank give it to the person who lent it to me? I don't know. I don't care. This is the financials of my trade. Understand? So that means that after a year, I would make $1,036, which is a return of 3.6%. That's the return of Yuqin and Ole. 3.6%. Close, right? Okay, now we'll go to the maybe Jonathan trade. I'm going to say, how about if I do this with $500? I have $500 in cash and $500 in cash in a year. Yuqin may say, wait, no, that is not allowed because $500 is not enough to buy 9 A's, which will cost you $900, right? But then it is true, I need $900 for that, but I'm also shorting 900, I'm also shorting 9 B's, that gives me $900. So maybe when I talk to my broker, I said, sure, you get $900 in cash. I use them to buy A, and I can still do the trade. It's unclear at this time. It's unclear. And certainly you didn't want to do that. The total is I make $36 as before, and now I have a return of 7.2%. Okay. And here we have what I call the impossible trade. This is Sophia. She said, hey, why do I need any money? You go to the broker, said, broker, short these B's, 900. No, you buy these A's, 900, and I make infinity percent. Right? I think I got everybody's in one of these three camps. Right? I want you to understand. I don't want to lose you. This is very important. I don't want to lose you. Okay. No, before like I said, no one is right, no one is wrong. But now I'm going to make a commentary about each of these three trades. I'm going to make a commentary. I start with a conservative trade. That's my commentary. It's great. 3.6%, is that good or bad? Are you happy with it? You're happy with it. Of course, it's your trade. You're not happy with it. Why? Okay, so let me ask you a question. What did the index do? What did the market do? We always need to compare, right? I mean, 3.6. What did the market do?
It went up.
How much?
Something between 5 and 10%.
Give me a number. Be a mathematician.
7.5.
7.5%. What do I know? I have only two pieces of information. I use them. 7.5%, right? It's a good guess. My market went up by 7.5%. I know that the first again vector is 1, 1, so it's gotta be 1. If it's not the S&P 500, at least it's your index, the one that you calculated on Monday, right? Yes, so the market went up 7.5%. So would you say that your 3.6 is good or bad compared to the market? Bad? Yes, why?
It's half, like that, like, better if I just invested in the market, like in the.
Okay, let me say one thing, okay? So thank you for that answer, by the way. That's the answer I was hoping to get. Oh, Leon has some.
Yeah, like if we lower our cash to only 300, then we are better than the market.
Yeah, hold on. Yeah. No, don't do that. I'm still talking about the conservative trade. I need to spend a lot of time because I need you to think the right way. And I have a theory. No one can explain anything to anybody. Explaining does not exist. Everything you learn, you have to learn on your own. So I will be your guide. You will learn something on your own. I'll just guide you. Okay? So we're going to stay with the conservative trade a little bit longer. So do you think it's fair, Ole, do you think it's fair to compare my conservative trade with the market? And don't answer. Imagine the market had done the following. Imagine A goes down by 5% and B goes down by 10%, which could have happened. I told you no one knows if we're going up or down, right? But I do know that, I suspected, I built this trade with one thesis. The thesis is not that the market is, the thesis was not that A is going up and B is going down. The thesis is that A is better than B. So if I'm a portfolio manager and someone tells me, oh, guess what, in a year, A would go down by 5% and B will go down by 10%. And I would say, I knew it. That's why I want to do this trade. What will happen in that case if A goes down by 5% and B goes down by 10%?
And then you lose the 3.6%, or it's still better than losing 7.5%?
So say that again?
You lose 3.6%?
I lose? Why? Why do I lose? A will be 945 and my short B Sorry, my 9As will be, I don't multiply in public, okay? I told you, it's very embarrassing for me. So my 9A will be, if A goes down by 5%, it'll be, will be 850 or something like that, right? And then a B would go to 800. So it's actually the same, 3.6%. If the market drops by 7.5%, but A is better than B. A goes down to 5, B goes down to minus 10. I make the same, 3.6%. Which is why I did this trade anyway. The good thing about this trade is I don't care where the market's going. I know B is better than A. No, I know A is better than B. Understood? Everybody understands? And the return is more or less the same.
No, I'm just thinking, why is it a conservative trade? Because I have
Hold on, no. Hold on. No, I understand. I just have to give it a name. What am I going to call it? The Sophia trade. I didn't know you were going to be here. I have to call it conservative. Yes. So we understand that. So this looks like a pretty smart trade and a pretty good return, taking into account that I don't share the same risk as the market. My risk is much lower. In fact, where does this portfolio live? Let's think like the first day. The main risk factor for any equity portfolio is the index, the first eigenvector. Not here. We got rid of it. This portfolio eliminates the first eigenvector. So why would you compare this with the market, which is exactly orthogonal to this portfolio? It's the wrong comparison. You understand? Laura, you understand? But and do you understand the eigenvalue interpretation of this portfolio? This portfolio is the second eigenvector. Here is very clear. I have two eigenvectors. The market, 7.5%, and the second eigenvector, 3.6%. So I think, it's very hard to compare, but I think 3.6% is pretty good compared to the market, because if the market goes down, which no one knows, I still do 3.6%. Okay, I'm coming back to this now. I'm going to move to the aggressive trade. Yeah, Ole, yes?
Do you find it easier to know that one company is better than the other than knowing whether the market?
Oh, absolutely, yes. Yeah, yes. Like I'm telling you, knowing the market is going up or down, no one knows. No one knows. But if A is better than B, yes, there's lots of metrics. Yes. It could be. Okay, let me go to the aggressive trade. I call it aggressive. I don't know. Again, I didn't know that Jonathan was going to be here. I was over to the Jonathan trade, or the Jan trade. Aggressive trade is because it looks like I'm taking some risk. And for most people, this is like, what? You can do that? You only have $500. How can you buy 9As, which is 900? Oh, because I'm shorting Bs. Oh my God, you're taking risks. Yeah, I'm taking risks all the time. If I don't take risks, I have no return. That's how we started this course. So it seems that there's no, but now 7.2, does it look good compared to the market? No, it looks fabulous compared to the market, because it's more or less the same return, and I don't have the main risk, which is the first eigenvector. I don't have it. So it looks pretty good. Would you change your mind? You're still happy with your conservative trade, right? Okay, don't worry, it's coming. Now let's go to the Sophia trade. Okay?
Yep.
Okay. So what's wrong with this? It looks like it all works. And you make a ton of money. My God, this is like the best. What's wrong? Anybody sees anything wrong with this?
say as soon as it doesn't go as expected, you're just highly exposed to
For sure, that's a very risky trade. I say it's impossible. I'll have to specify what I mean by that. For sure, it's very risky. I agree with, and even you agree with that. Yeah, she knows it's risky. But I said, what's the problem? This is a fund. If it goes bankrupt, goes bankrupt. It's none of my business, right? But if you make a lot of money, you get 20% of that. You're the hedge fund manager, right? Right? Yes. Exactly. So it looks like you're on the winning side no matter what. So let me tell you another story now. And the best way to explain this is with a story. It's a metaphor now. It's a metaphor. What I'm going to say now is not 100% correct. It's actually, there's some historical exaggerations that I'm going to do. Allow me that poetic license to introduce historical exaggerations, but then you will understand what I'm trying to say. I'm not trying to tell you a story which is actually exaggerated, but the purpose of my story is that you understand the last 50 years of trading. Okay, there's a lot to learn from that example here. Okay, so there was this hedge fund called long-term. What I'm saying is an exaggeration. It's a poetic exaggeration. Sorry? Yes. So there was this hedge fund, Long-Term Capital Management. Have you heard of that? Okay, well, if you haven't heard of that, now is the time. So there was a hedge fund. I have to give you some information. There was a hedge fund that was set up by someone by the name John Meriwether. John Meriwether had a fantastic reputation in Wall Street. He worked for Salomon Brothers, made a lot of money for Salomon Brothers. And one day he says, you know what? I'm going to just do this on my own, not with his own money, with investors' money, but then he set up a hedge fund. And he was collecting 20% of the performance fees, like hedge funds do. He did what we did on Monday. And he was not doing stocks, not A, no B. He was doing other things. He was doing bonds. For example, there would be a 30-year bond in the market and a 29-year bond in the market. And the 30-year bond in the market is what's called an on-the-run bond, and he was selling good liquidity and this and that. And then there's this bored 29-year-old bond in the market, ugly bond, no one wants it. But it's almost the same. So I can buy this cheap, right? I short that expensive. Every so often I have to make up for the difference in coupon payments, almost the same in time. I just wait, and in 30 years I make a little bit of money. But if I can make a little bit of money without investing anything, that will be a lot of money. So he did that with billions. Billions. And that was long-term capital management. When you talk about long-term capital management, most people think of Myron Scholes and Robert Merton, who were the directors of the fund, and they got the Nobel Prize in economics in 1997, just a year before. But we now know what the directors of a fund are. In the diagram that I gave you for a fund on the first day, there were the investors on top, remember? The fund in the middle, and then the service providers at the bottom. So John Meriwether was running the management company. These guys were the directors of the fund. So the trading decision was not made by them. People thought they were the ones making the trading decisions. They were not. They were just the directors. They just had oversight over what the management company was doing. Okay, so that's, again, to tell the story correctly, that's what they were doing. In fact, it seems that there was a directors meeting where they advised the management company to lower the risk because it was too high. So that's just to correct this metaphorical exaggeration I'm giving you so that you understand what's going on in here. So John Meriwether was going to say, I'm going to do this in the billions. Because in the billions, this will make money. Even if you return, if you were making $36, that's a lot of money. He would make a lot less than that. But if you don't need any money, you can do this in big volumes. So he went to the banks, and this is what the conversation essentially was. And now I'm paraphrasing, of course. He would go to who wants to be Goldman Sachs? You're Goldman Sachs. Go to Goldman Sachs and say, I want to do this. You want to do it? You know me, I've been trading with you like for 20 years, right? And you said, John, are you crazy? I said, no, I'm not crazy. I want to do this. And they said, well, you have to put some money down. I said, no, I'm not going to put any money down. Why would I? I can do it. And you can finance it. And then you say, it's too risky for me. That's what you say, right? And then I said, oh yeah, then I take the business elsewhere. Look, JP Morgan is waiting right here. And these $9, look at the $9. These $9 go to JP Morgan. So Goldman Sachs says, okay, I'll do it. They want the $9. You understand? So the $9 there almost went unnoticed for you, right? Well, that's big bait for a bank. That's how the banks like to make money. By the way, the banks don't like to make money by trading, and they like that's how they like to make money. $9. And then he goes to JP Morgan and says, JP Morgan, I want to do this. Oh, John, good to see you again. You want to do that? He said, yes, I want to do that. And I said, but no money? He said, no, no money. Why? But that's a lot of risk. Oh, you don't want it? I bring it to Goldman Sachs. I said, oh, no, I'll take the $9. Just stay with me. And then I go to Merrill Lynch and I go to Morgantown. You understand? So by the end of the day, I got it. So yes, we're going to call you Sophia Merriweather. You understand? What happened now? So why do I call it the impossible trade? Because this was in the year 1996, 1997, something happened in 1998. In August of 1998, there were two very big events the same week at the beginning of August of 1998.
Something in Thailand, let's say? Something in Thailand?
That was 97. I know everybody thinks that. No, that was Thailand. That was 1997. That was the year before. Yes, no. It was 1998, the first week in August or the second, towards the beginning of August, 1998. What happened? Two events. One in Russia, one in the United States. Same week.
It was default, right?
Exactly. That's when Russia defaulted on their bonds. That was the first. That was a shocker. Because perestroika had just started and the world was like, what? Okay, so it was bad. It was bad for credit for the world. But there was a second one that just made it like incredibly bad. Monica Lewinsky. Do you know Monica Lewinsky? You know Monica Lewinsky? You don't know Monica Lewinsky? What?
Bill Clinton's intern.
Yes, that's right. So Bill Clinton was impeached in Congress for his affair with Monica Lewinsky. Then markets were very afraid because Russia just went down, and then they thought the US is going down next because he may be impeached in the Senate, then the US has no president, and oh my God. So credit markets, not equity markets, credit markets dried up. You call for a loan? He said, no. You want to issue bonds? No. Nothing. It wasn't stocks, it wasn't A's or B's, but John Merriweather had bonds, swaps. He had something in Russia too. And then what he was confronted with was, if I can, again, continue with my metaphor, my exaggeration, is he sees that A is going down in price. These are the ones he was long. Those bonds no one wanted. And B, the bonds everybody wanted, that he was short, go up in price. See that? So now I'm running a very negative balance with all of my brokers. And the brokers called me and they said, you gotta give me some money, buddy. This is like too much. And then I say, I don't have it. And then they say, collectively, the bonds were about $1 trillion in notional. So the bank said, who do you call? Who do you call?
I think they call it the government, right?
The Federal Reserve Bank. I said, we have a problem. We have a very big problem. So then the Fed stepped in and this and that, and the London Capital Management, the fund just died. The investors lost almost everything. These bonds were liquidated with a very careful manipulation of the market, so nothing would blow up. And that was 1998. January 1st, 1998 is when the banks had the first modern risk management regulation that was made for market risk, called Basel I. But this is not market risk. This is credit risk, because it's your exposure to a counterparty that may not be able to pay. We saw the taxonomy on day one. So then the regulators got to work really fast and said, okay, how do you stop this? You see, every time something bad happens, there's a reaction, and the reaction is regulatory, typically. And then something happened, something developed, which is what we call Basel II. And Basel II said, how can we make this not happen again? So before I tell you what they did, let me ask you what you would do if you were regulators. What would you do?
With margin accounts. Margin accounts.
Okay, so you could do that, but see, the margin account is difficult because you are a regulator for the bank.
Bank need reserves. Reserves.
Okay, yes, exactly. So we're going to that. So what they basically said, the banks, do your business. I don't have access to your business. You do what you want. You want to charge 9, charge 18, do whatever you want. I cannot do that. But now, from now on, the risk which is in that book is your risk. And that risk, I impose a certain charge, and that comes to the central bank. So you put this money here. Now the bank says, I can no longer do that for free. The risk, the collateral I have to have with the central bank is so high that the $9 are not worth it. They are worth it for the conservative trade, because the risk I have with the central bank is zero. No collateral, the $9 are for me. For the aggressive trade, the $9, I'm exaggerating, half is for me, half is for the bank. You know what? I'm still happy with that. But this one, no, I cannot do it. And that's how the regulators stopped trades like this. And that's why this trade has been impossible since 2001. Understand? Good for you. You just learned 25 years of history. I'm not exaggerating. You learned 25 years of history. This took 25 years to develop. And it was exactly on a trade very similar to this long A, short B. Congratulations. This is good knowledge. This is more important than most of the things you can learn in risk management courses. You cannot understand risk management without this example. You cannot understand Basel II without this example.
Can you shuffle repeat that again? What was the mechanism again?
I'm going to tell you. It's right here. So the central bank will now tell the banks, this risk is your risk. Then the bank says, oh really? Then I have to pass those requirements to my customers. So now what the banks do is they calculate the risk of your portfolio. They know how much money they have to send there, and they ask you for at least that. But of course, the banks are not going to disclose to you what their obligations are. So the banks have come up with a very simple method to ensure that the cost of your money is good enough for me to give my reserves to the regulator. Okay? And I have here an example of how that margin works. So the bank is going to ask you for 50% collateral on your long positions and 80% collateral on your short positions. We're going to go a little bit, let me stretch your patience a little bit, okay? And then I'm almost done. I cannot stop this story right now. I'm sorry, I have to finish, all right? What does that mean in our case? How much money do we need for this?
1 times.
I'll show you. So this is how we do the margin calculation. And then to do long A's, to the 9 long A's, I need 50% of $900, which is $450. To do the 9 shorts, I'm going to need $720, 80%. I'm going to get $900 of short interest income. Sorry, of shorting income, short selling income. I have $900. So the result is I need $270. So I can do this trade in the limit for $270. So the Sophia trade now, to be completely regulated, will be $270. You understand that? And by the way, if A goes down in price and B goes up, that number will increase. And that's called variation margin, and I'll ask you for a little bit more tomorrow, if that was to happen. If A goes up and B goes down, then you'll need a little bit less. And so you can take some of the money from the 270. That gives you the limit of what you can have. Understand? Understand? Good. Okay. So the optimal trade is now this one that you have in front of you. I still make $36, which gives me a return of 16.67%. It's the best I can do. All right? So we've understood many risks now. But there's an additional risk that maybe you've never heard of. Yes, a type of liquidity risk, that's right. Because what will happen if you do this trade with $270? What will happen?
You cannot move it.
The minute A goes down, you're out. If A goes down a little bit and B stays flat, they're going to call you for a few cents. What are you going to, you don't have a few cents. This is all the money you have. What do you have to do? You have to sell A's. You have to sell your stocks to pay back what you need, right? And that would unbalance your portfolio even more. You may have to cover some shorts. A mess, very bad. You will be damaged, right? And now that brings me to another thing that happened, another story. And this story happened on August 13, 2007, August 9, 2007, August something, around August 10th, 2007. I had the privilege of living through that also in firsthand, which is something that is very hard to find in any book. No one talks about that because it's actually not visible. But it was visible here if we had been able to download the data yesterday, because it shows up. It doesn't matter. I'll tell you. I can tell you a story, but I'll explain it like this. Imagine this. You know about the subprime crisis that was ignited March of 2007. And it actually started with the blow up of 2 hedge funds run by UBS in Zurich. Actually, in New York, UBS in New York. People got very scared because they realized that the credit bubble had inflated asset prices, and who knows what was behind that. And because of that, then what had happened is the big asset managers, and I imply nothing by saying this name, like Goldman Sachs Asset Management, received a lot of redemption instructions from their investors. So everybody had a lot of money that they had to sell, but usually you have a little bit of time. You have some liquidity period. We went through that on Monday. You don't have to sell immediately. So these big companies were looking for, the rumor is that this was Goldman Sachs, but I don't know. They had very big outstanding redemption orders, which means they had to sell a lot of stuff. And by sell, I mean sell if you're long, but buy if you're short. They had to unwind a lot of positions. And it's very hard to do that when days are very volatile. So let's go to a very quiet day, middle of the summer. It was very hot in Toronto that day. And I said, well, today's the day. So what I'm gonna act as if I'm Goldman Sachs Asset Management, assuming this was Goldman Sachs, could have been anybody, but I'm gonna be the big bank, yes? And we went to school together. We all went to Columbia. We did the same MBA. We, by the same age, we settle MBs. We do the same thing, right? But each of you does it for your own fund, and I do it for my clients. And I'm a lot bigger than you. Understand? Okay, so I'm gonna have two groups of people here. For sure, Eugene and Ole are on the $1,000 camp. You are the guys who have plenty of liquidity, okay? For sure, Sophia is gonna be on the $270 camp. You're there with $270, right? And maybe someone else is with her. I don't know who. I forgot now the numbers that you gave me. I remember all the extremes. So you decide where you're gonna be. You're gonna be with her or with her. It doesn't matter. No one's gonna lose any money, okay? But I just want to explain to you what's going on. Because what's happening is this, the market opens and then suddenly, without any explanation, all the A's go down. All the A's in your portfolios go down. All the longs go down. All. And all the shorts go up. And you're there and I said, what is going on? This is not one, all of them. And then what you do is you're wondering, you say, well, this is strange. Maybe you guys are worried. You are in deep trouble, right? Because I'm calling you. I said, Sophia, I need a margin call. And you said, I don't have the money. I said, well, start liquidating because, okay. And they said, oh my God, what shall I sell? Right? And then while I'm doing that, Eugene is saying, I need to find out what's going on. And she knows what to do. She calls me for information because I'm the broker. So you call me for information. I say, Eugene, I put you on hold. I say, I'll put you on hold. I get a call from Eugene. I say, what's going on? I say, oh, sorry, I cannot talk to you. I'm doing a margin call. Bye. And then she says, oh, I know it. Sophia's in trouble. I'm sure Sophia's in trouble. You went to school together. You know exactly what. You understand what I'm saying? Yes? And then, what do? You call Ole. Said, I don't know, but I think Sophia's in trouble. Have you noticed how A's are going down and B's are going up? Said, yes, I was wondering myself. Said, I called the bank, they couldn't talk to me, they're doing margin calls. I think Sophia's in trouble. You call Sophia, she's not picking up. I think she's in trouble. Right? And so you would be either with them or with her. You're in the middle somewhere. Okay, you decide where you want to be. All right? Okay, you're done. You're done. Okay? What happens after today? I don't know, look for another business, look for another job, you know. You're going to go work at the Edeka. They may take you, whatever, you know. Okay? Well, what do you do? What do you do? Huh?
Rebalance?
What I would do, if I was you, rebalance, I don't know if I would call that rebalance. What I would do is, first of all, today you do nothing. Okay? You wait until tomorrow, maybe. Because you don't know how deep this trouble is, right? I mean, you are very, very safe. You have $1,000, my God, and it's $270, what is required, you're fine. But at some point, you're gonna break your risk aversion. You're gonna break it. I said, damn, I should buy a little bit more A's, right? Maybe I invest $10 more, right? And you do the same. And those of you who survive do the same, which means you will have a fantastic day after tomorrow, but you survived the day. And that happened. And you can actually see it in the data we could not download from yesterday. We can actually see it. The day is there. I'll show you. We saw it yesterday. We saw it yesterday. I was hoping that you would find... at this point in time here, I now ask you for the date, and you can tell me the date. You could have told me the date if we had managed to download the data from yesterday.
2019, 2020?
No, 2007. Because that would be in your spreadsheet if you had been able to download the data. And so this is so bad that we couldn't get the data, because that number is there. You say, oh, it was August 13, something like that. You'll see it there. But we don't have it, and you can look at your fake data. I doubt your fake data has that outlier. I don't think so. You need to be a real hedge fund to have this. You understand what I'm telling you? And this now you can these are risks piled on top of risks, and you need to understand all these things. And this is one of the things which is so hard to do when you are when you're managing, because you have to. Now we're doing cash management, and cash management is actually very difficult to do because you need to take into account this. I'm just telling you here the story that we went through. Okay, we did that. So you don't recover. Even if your margin call is very small and you don't recover. You have to rebalance your portfolio, you have to unwind your portfolio, you have to do something to it, and then your portfolio is completely screwed up. So margin calls, now you have seen how a margin call is generated. In fact, one of you was subject to it. So we've seen short squeezes today, we've seen margin calls in a very, very realistic environment. That's how they are. Okay, now I will end with one thing. You can actually calculate the probability of a margin call. If you have it, and the reason is because, so if I have an excess margin equal to A, and if my portfolio is Gaussian with the standard deviation sigma and mean mu, the probability of a maximum loss is a very simple calculation, which is a consequence of something that you may have seen. It's called the reflection principle, or heating times. Have you seen that? You've seen heating times, you've seen the reflection principle. So that will give you this number. You can go through the calculation. It's exactly that. And that's why if your margin is 270, so have zero excess, the probability you get a margin call is 100%. But as you go away from it, it's less. And that's a risk we have never seen before. It's a new risk, it has no name. But you have to take into account. And in the act of investing, there's some risks which we know is standard deviation. There's some quantity that we know, Sharpe ratio. And there's others that are just there. And some funds have people like you whose only job is to calculate this, make sure that we don't get a margin call. Because if you're a mutual fund and you get $1 billion to invest, you invest $1 billion. You have to be long $1 billion, short nothing. But if you have freedom, like hedge funds have freedom, then how much money do you go long and short? I don't know. It's a risk-based decision. And by now we have seen if you take risks and you increase your gross exposure, you will have better returns, but better risk. What's your sweet spot? I don't know. Eugene will take very, very conservative position. Sophia will take a more aggressive position. Your return will be very good. You will live longer. You will make more money. You understand? And this is how this business works. So I'm done talking about stocks. I should have finished like 2 hours ago. I hope you're worth it. I hope you understand what we're talking about. Because these things, if I write this in math, no one will understand anything. I don't even know how to do that. But I think now you realize how a lot of the math finance you have learned is actually at the service of this. And the risk management you may have seen, like Basel II happened because of this. Okay? If I was talking about option trading, I would have explained to you how Basel I happened, because that was October 19, 1987, but I'm not talking about that in this course. All these things happen for a reason, and you need to understand the reason, and then everything is very clear. Now you understand Basel II. There's nothing else. Basel 3.5. If I talk about 2008 a little bit more, then I'll explain to you why Basel 3.5 exists, or the Dodd-Frank Act, or anything. You need to understand what happened. Let's go for lunch. 1:30. We meet at 1:30. I have more trading styles. I need to do at least one more, okay? Which is great. So I don't know what I will do when we come back. I may lecture for another hour or something. I don't know. I will decide. Okay. Now let's go have lunch. So I'm going to now switch to talk about bonds. And I'm going to focus on a particular type of bond, which is convertible bonds. It's a bond with optionality, and it makes for very interesting situation, very interesting strategy. So some review of financial products financial instruments. If you're a company and you need money, what do? The first thing you do if you need money? Take a loan, issue a bond, go to the bank. Always the first thing you try to do is get someone else's money. You pay interest, and you're done. Let's say that does not work. You go to the bank and say, issue bonds, no one wants them. What do? You issue stock, yes. Okay, you issue stock, do an IPO, do something, issue stock. Great. Why? Why is it better to issue a bond than issue stock?
Usually the cost of capital is higher for equity.
The cost of capital. What does that mean?
So there is an expected return that investors want to achieve from the stock.
Yes.
And
But you are the company, right? What do you care about the investor's return on capital?
I mean, I do care about my shareholders, right?
No. The only thing you want from your shareholders is their money. If you're the owner of the
They
company,
won't give you any money anymore if you wouldn't.
okay.
meet that target.
I thank you for your answer. Yes, it's very good. I'm going to spend some time talking about that. I'm going to listen to Ole first, and then.
If you give them equity, you have to share the upside.
That's right. That's what's really bad. You have to share the upside, and you hate that. You hate that. A bond is much easier. You just pay the interest, and they won't bother you. But their shareholders can bother you. Imagine they become majority shareholders, and they tell you that you have to do things in your company that you didn't want to. I'm sure it's your company, right? You are the shareholder. If you're the CEO, that's a different story. You work for the shareholders, but the CEO works for their money. So yes, you're right. You care about the shareholders, but that's if you're the CEO, not if you're the owner of the company. The perspective is very different. The CEO works for the shareholders. And you say, oh, the shareholders have changed. Oh, okay, so my jobs have changed. What do you guys want? But if you are the owner of the company, the shareholders bother you. They will tell you what to do. Or, as Ole said, if things go well, you have to share with them. And if things go bad, well, you lose everything anyway. They won't help you. Right? A bond is always a better idea. But sometimes it doesn't work. And why do investors typically prefer stocks to bonds? Because of the upside. I haven't heard anybody tell me how proud they are that they made 3%. Guaranteed. Forever. Without the hope of making more. But many investors, that's what they want. German insurance companies, that's all they want. 88% of the portfolio of a German insurance company is bonds because they like it boring, but reliable. And they consider stocks to be very risky. They don't want the risk. But that's the investor's perspective. The issuer perspective is you want to keep your own home to yourself. You don't want to give the kitchen to someone else. Right? Okay, now what happens if both fail? No one wants your bonds, no one wants your stocks. What do you do?
Borrow from bank? Borrow from bank?
No one wants to lend you money. Not the banks, not your friends, not your family, not the government. No one wants to lend you money. So bonds, loans, doesn't work. You want to issue stock. Still no one wants it. What you do is this, and this is a very recent discovery. This is from the 1970s. This is how the thinking goes. Bonds, now you have to adopt the investor's perspective, right? What do bonds have which is good? Why do people want bonds? Reliable. Security, certainty. You get your 3%, and they're backed by your assets. You don't pay, I take your chickens. Right? Why do investors want stocks?
Share the profit of the company.
They do that to participate in the upside, as you said. If things go bad, that's what they don't like. If things go bad, what happens? They lose maybe everything. So the process of the bankruptcy is such that in the case of bankruptcy, there's a lineup to collect your assets. And in the lineup, the first entity in the lineup is the government. They collect their taxes. No one gets paid until you pay your taxes. After that is the legal team. The lawyers, the judges, the liquidators, they get paid next. And whatever is left goes to the bondholders. And because you're bankrupt, there's nothing left after the bondholders collect all of their debt. And the shareholders have nothing. That's how it works, yes? Okay. But if things go well, the government, you just pay the taxes. There are no lawyers, no liquidators, nothing. The bondholders collect their 3% or whatever it is, and everything that's left goes to the shareholders. So how about if bonds and stocks don't work? What you do is you create a new instrument which contains the best thing of stocks and bonds. In other words, it contains the worst thing for you that stocks have and the worst thing for you that bonds have. How about that? That's a convertible bond. So how does it work? You can think of it in different ways. You can think of it as a bond that pays and is secured by the company assets. But if things go well, you can turn your bond into stock and then you collect all the upside of a stock. From your perspective of the issuer, you have to give them back their money if things don't go very well. I'm not making, well, you still have to pay the 3% and the money back. And if things go well, damn, they change lines and they go and I have to share my profits with them too. So it's the worst thing for the issuer, but it's the best thing for the investor. That's why you do it as a last recourse when that's all you can do. The company that did this very well was a telecommunications company called MCI. That was the first company that challenged the AT&T, American Telephone and Telegraph, AT&T, the North American telecommunications giant. And they did it very well. They raised a lot of money and they did fantastic. And then they became a neck-and-neck competitor with AT&T. So it works in practice. So that's great. So what do we do now in this context. The thing is that because we're talking about a special type of bonds. These are bonds which you should know that if you want to invest and obtain good returns, you should do what no one else is doing. Because if you do what everybody else is doing, typically prices are very compressed and there's very little for you to gain. So, and as I mentioned earlier, if you do something which is innovative, then you have a chance of making it work for you. So as an investor, now we're thinking of an investor, we're not a company anymore. As an investor, I like convertible bonds because they may give rise to inefficiencies. It could be an inefficient market. And if there are inefficiencies, there are returns. We take risks for that. We're going to understand the risks. We're going to understand why the risks gave return. And we're going to understand how to mitigate the risks to turn the return into a very profitable investment. That is what I'm going to do today. And I'm going to do that with an example. Convertible bonds, as you can imagine, they are issued by companies which are so-so. Apple would not issue a convertible bond. In their normal mind, they may do it for whatever, strange reasons, but normally not for financial reasons. Right? Companies issue this under pressure. So what investors do is they say, sure, I'll buy your bond. In other words, I'll take this position in the company, which is I'll be a debt holder when you're so-so, but if things go well, then I become a shareholder. That's what the investors are. But that poses risks, and you're dealing with companies which are very risky. So what is the first thing that convertible bondholders do? Is they hedge the company risk by shorting the stock. So you buy a bond, and you hedge some of that risk by shorting the stock. And we're going to see how that works. All right. So I'm going to do everything with one example. I have a convertible bond that sells at $80, 80. That gives you a 20% discount. Do you have an idea what the credit rating of this company might be? B as in bad. Okay? Maybe triple C even. Maybe. You understand that, right? What's the recovery rate for a bankrupt bond? What is the value of a bankrupt bond? It's about 50 cents in a dollar. The average is about 50 cents in a dollar. You've taken a course on credit risk? No? Oh, a pity. Okay, so then just remember these numbers, okay? This is far from a course, far from a theory. Remember these numbers. A bankrupt bond is typically worth 46 cents in a dollar, say 50. $80 is good, it's much better than 50, far from bankrupt, but far from 100. Okay, so that's like a mid-B territory. Okay. This is a convertible bond, because no one wanted this bond, which can be converted to 10 shares at any time, and the stock price is $7. So the math works. When you buy the bond has to be worth more than $70. Otherwise, you just get the bond, convert into stock, and you make money immediately. So these numbers work. Stock price 7, and the convertible bond will give you 10 shares anytime. And I'm going to assume annual coupon payment of $4, and interest rates are also $4. You will see why I have to consider interest rates to be non-zero now. Is that clear? You understand the context? And we want to make money. We want to make money. How do you make money with that market in front of you? You can say, I'm going to buy the bond and hope that it goes up. I want to buy the stock, hope it goes up, but neither of those will be very good trades. We're going to have a better trade by combining a long bond with a short stock. So let me show you. I'm going to go long the bond, $80, and short the stock. I'm going to short 10 stocks, $70 short. I'll tell you why later I am shorting 10 stocks. You say, why are you shorting 10, not 5 or 12? Well, 10 is the maximum that will convert my bond into. So it's doable. And let's say that I do that trade. I buy my bond with my $80. I short my stock. That gives me a liability of $70 in the stock. But it also gives me some cash, some money. And that cash, I'm going to invest it risk-free. I'm going to say I buy a T-bill or put it in a savings account, something. But I want the 4%. I want the 4% from the T-bill that matches the 4% that I will get from the coupon payment. 4% on the notional of the bond, not on the actual value of the bond. The value of the bond is actually higher. So a year later, if everything is the same, I'll have my $80 from the bond, same price. I have my $70 liability on the short position of the stock, same thing. I have a coupon payment of $4. I have my T-bill that gives me 4%, so that's 72.80. And I'm going to pay borrowing fees for the stock. And I'm going to use the same 1% as I did before. But because rates are 4%, my 1% cost turns into a 5% borrowing cost for the stock. So in other words, $3.50. Okay? The net of all of that is I will make $3.30. That's what this trade will give me. How brilliant is that? We always calculate returns as excess from the risk-free rate, always. We always assume 0% risk-free rate, so the return that was given to us is what it is. But because now I have 4% risk-free rate, this return I have here is only 12 basis points higher than the risk-free rate. So is this trade worth doing? But we do the same thing we did earlier. We compared our portfolio with the market and said, this is a good deal. Is this trade worth doing? All of these operations to make 12 basis points, is it worth doing? No. So either I'm a bad investor, or this is not the reason why I'm buying this bond. This is just one scenario. Many things could happen. Let me consider what will happen if the company goes bankrupt, if the bond goes bankrupt. If the bond goes bankrupt, what's the value of the bond? I take the average value. I don't know anything about this company. I hope I get half of my money back. Say $50. After they liquidate their buildings and their trucks and whatever they own, then $50. Or maybe a company goes and buys the company half price. And then I get, they will not buy the company before I negotiate my bond. Otherwise, my bond will go back to $100, right? Typically, if you buy a bankrupt company, you negotiate with the debt holders. They say, how about I give you 50 cents and you go away? Say, sure. Okay, and you buy the company half price. Good. You understand that? $50 for the bond. So you've lost a lot of money. But what happens to the stock? The stock went to zero. So you made $70 because from $70 of a liability, you go to zero, right? And the cash, well, no coupon payment. The coupon is part of the recovery. It's part of the $50. So forget it. You're not going to get paid. You already got paid with the $50. Say thank you. And the T-bill that you invested, the $70 that you obtained in cash from shorting the stock, goes into the T-bill. That will give you the 4% because the US government has not defaulted yet. 72.8, that's what you have from your cash. And you still pay the shorting fees, $3.50. The net result is you make a lot of money. That is 50%, 46% above the risk-free rate. So I think we have a pretty good idea why the manager did this trade. Let's spend some time on this, because there's something very interesting here, right? Understand, Sophia, what's going on?
I mean, I want to invest in the company, like buy the bond, but I want the company to go bankrupt.
Exactly. So this is a very interesting perspective, because maybe what this manager was doing was something different, was shorting the stock, right? Maybe this was a short stock trade. And that's how you're going to make the money. And then you buy the bond to hedge your short, right? Why would you hedge your short? Imagine the company is bought by Microsoft tomorrow for twice the price. My God, you will lose 200%. But not here, because, oh, Microsoft bought the company. Damn, I thought it was going to go bankrupt. Microsoft bought the company. So what do? I convert my bond into stock. That gives me $140. I owe $140 because the stock went up in price twice, right? And the coupon payment I don't have because I turn it into stock. I get my cash back. I pay my fees. Oof, I didn't lose money. You say, oh, you lost 70 cents. I lost 70 cents? I could have lost 200% if Microsoft buys this company and the price doubles. You understand what I'm saying? So this is very interesting, because now you can look at such a trade either as a convertible bond with a hedge, which if you're betting for bankruptcy is pretty weird, or as a short with a hedge, which if your view on the company is negative, is a very smart trade. You see? Okay, this is how you trade convertible bonds. How would you trade convertible bonds in Asia? In Asia, it's very hard to short stock. So you have to buy them naked, which is without protection. You can't short. So the convertible bond market is much thinner, because this is very difficult to short the risk. Maybe you could buy a put option. It has the same effect. If you can buy puts, but if someone is selling you puts, that means that they should be able to short the stock. Otherwise, they take the risk. Someone has to take that short equity risk, right? So this is why this happens in developed markets, where you can actually short at reasonable prices. You understand what I'm saying? So this is the context in which we're doing things. Okay, so now I could do, just for fun, I can do some more scenarios. I have, what if things are slightly worse? Say the bond drops, the company does worse credit rating, it drops. The stock drops too, right? Normally bonds and stocks, they go the same way. From a corporate perspective, interest rates will affect them differently. If interest rates go up, bonds go down, and maybe stocks go up or down, depends on the market. So, but in this case, we can assume that. And then the financials of this will look like that. I make some money. Look, I have 4% over risk-free rate. So my first scenario is pretty good. My second is just so-so. I have LIBOR plus nothing, right? You understand what I'm saying? And I can go to my next scenarios where everything is better. And of course, if everything is better, then of course I'm going to do worse. Because by now we know this was a bearish trade on the company. Okay? So the profitability of my trade is predicated on the spread between the bond and the stock, with the protection that if the stock drops to zero, I make a lot of money. And if the stock increases in value, I am protected because I can turn my bond into stock. But now comes the question, how did I decide I was going to short 10 stocks in a bond? The only reason I did it is because I was making a bet on the company going bankrupt. And you can see in that scenario, I make a lot of money. In all the other scenarios, I'm so-so. So let me then tell you how this thing works in practice. The way it works in practice is as follows. And I have a tree-based explanation of how we do this trade. I have the bond, $80 now. And I hire an analyst, someone who took the FIM program from TUM, and I say, tell me what could happen tomorrow. Give me some scenario, not tomorrow, next year. Give me some scenarios. And then this FIM student says, oh, spends several days working on this. I've come up with an answer. The answer is this. They said 33% chance this company is bought by Microsoft and the price will go to, I guess, 14. Understand? Right. And then, of course, the bond becomes 14 because I can convert. They said 33% chance nothing happens. The company still continues to stay there and just suffer. And there's also a 33% chance the company goes bankrupt. And in that case, I think the recovery rate is 30% because this company is not doing very well. I don't think anybody will pay more than 33% of the value of the company. So these are my scenarios. You see yourselves doing this job, right? Right after graduation. A few years after graduation, you hire someone from FIM to do this for you. You should be the big boss doing the big trades, yes? Okay, so if this is the scenario that you have, what trade do you do? What trade do you do? How do you build the trade? Would you short 10 stocks for the bond? You make a lot of money if the company goes bankrupt, but that's only a 33% chance. Would you not hedge? There's a 33% chance you lose a lot of money. You short 5 stocks? Why 5? Where's 5 coming from? You guys are mathematicians. You should be able to write me a little equation and tell me what that number should be. No? Before I give you the answer, I want you to give me the answer. How would you go about doing this trade? What would you do? Any ideas?
Can we do it?
Hmm?
Can we do it kind of half-half?
Be a mathematician. Don't do that. Don't do that. Let's do it like this, all right? Let me set up, the first thing you do as mathematicians is when you're looking for a number that you don't know, you give it a name. In this case, I'm not going to give it a Greek letter name. I'm going to call it X, because I only have one. When you have one unknown, you call it X. If you have many, you start working with the Greek numbers. Okay? So call it X. And X is going to be a number between 0 and 1, so it's going to express a percentage. So X equals to 0.5 means 5 stocks. What percentage of the convertibility would you hedge? Pick that number X. And then as a function of X, once I know what X is, I can build the different scenarios of what my profitability will be. That's my accounting based on a parameter X. Parametric accounting. It'll blow the minds of any accountant. But you understand what I'm saying? You understand all the numbers there? Do I have to walk you through them? In the first scenario, the stock is going to, the bond is going to, the stock and the bond both go to 14, so for 140. My short position, which was 70x, becomes minus 140x. I'm doing just the accounting of my stock holding valuation. My T-bill is the same, 72.8x, because X is what I get in cash from shorting the stock and goes into a T-bill. Coupon 0, because I don't have a bond anymore. And my fee is 3.5x. You understand? That's first scenario. Then second scenario, and then third scenario. That means that I know at the end of each of those scenarios what the value of my portfolio will be as a function of X. Right? All right. What have I gained? What do I do now? What do I do now? I know the value. Have I answered the question? What would you do? Now, this is the third day we're lecturing. You should have an idea of what to do now. Something. I'm not saying it's the best idea, but at least some idea. How do you pick X?
We use probability, like calculate for expectation, and then we have X, and we try to maximize the equation outcome.
You try to maximize the expectation? Is that what you would do? No. Yeah. Okay, so Eugene will maximize the expectation of my trade. Yes?
Yeah.
Okay, that's great. And that actually, I'm a little shocked because in the previous trade, you were the most conservative. And now you don't care about the risk. I just want to maximize the return. I put all my balls on the bankruptcy. My chips all going to bankruptcy. This company is going to go bankrupt. And that's what you're doing, right?
I will like take one third probability for each and then sum.
But you are maximizing the expected gain.
Yeah.
So it's great. But see, in the previous exercise, you were minimizing the expected gain. You just wanted to minimize the risk. You said, "Oh, $1,000. I'm not going to," right? That's interesting. You changed. I don't know what you had for lunch. And I actually know what you had for lunch. But you changed. You went from very risk averse to being a diehard risk taker. Or maybe is that stocks scare you and bonds don't. Or maybe you're a very experienced convertible arbitrage trader and the stocks you don't feel very comfortable. I have no idea, but it's interesting that you changed. Everybody knows that she changed, right? Yes? Okay, now, Sophie, now you tell me that you
I want to be positive in all the scenarios.
you want to be positive. Oh, okay, that's what you want. You want to be positive on all the scenarios. Is that possible? I don't think it's possible. Is it possible? I don't know that you can do that.
But I will try at least.
You will try. I don't think these lines, they have anything positive. I don't think so. You can do that. I don't think so. So, but anyway, so that's interesting because now you are the least of a risk taker. I said, whatever happens, no, just, I want to lose as little money as possible, right? So you notice that she flipped too. I don't know what this lunch did to you. She went from being a big risk taker to being now as the lowest risk possible. Jan, what are you
I don't
doing?
know if it's the right application here, but maybe maximize the Sharpe ratio.
That's what I would do. I would maximize the Sharpe ratio. So Ole and Jonathan, I'm not going to ask you. I got my 3 answers, okay? So maximize return, minimize risk, maximize Sharpe ratio. Yes? I mean, I can think of many more answers, but basically that covers the whole thing. You understand? Let me do that. That was my choice, by the way. Maximize the Sharpe ratio. So what I do is I write the Sharpe ratio as a function of X, which I can easily do. I just need to program you get an answer?
I guess they're interested.
Eh?
I guess there is an answer.
No?
Should be.
There should be. Okay. I'm interested. By the way, you can write this down on your essay. I mean, we're going to do this, I think, in the afternoon. Okay, so let's maximize the Sharpe ratio. So I have here the Sharpe ratio as a function of X. Right? So what would you do, Jan? She's looking for the value of X that would minimize the losses. And okay. And
It seems to be that the Sharpe ratio here is maximized at around 8 stocks.
that's right, 8 stocks. That's what you would do. So you will short 8 stocks. Yunchin, I have no idea what you would do, but You just want to maximize the expectation, which is I don't know when that is. Probably bankruptcy. Maybe you want to short-term stocks. That would be my guess. I don't know.
But if you short these stocks, it will be positive in every scenario.
Oh really? Oh yeah. Okay, maybe. Okay. Well, there you go. Okay, so you end up with the same trade, but from a very different risk appetite perspective. Yes. Okay. Yes.
Could you do this trade theoretically also with puts instead of short?
Yes, you could. Yes, of course. And then so now you can read your own chapter on this, right? You understood. Because if you're buying the bond and you want protection, the protection is against what? Against the company going bankrupt. They say, well, wait a minute, you already have the bond. I know, but it's not enough. I can do better than that. That's the beauty of this trade. Because the convertible arbitrage gives you some safety, but you can make it even safer by shorting the stock. And then someone will say, wait a minute, but aren't you scared that the company is going to be bought by Microsoft at 5 times traded price? I said, no, it's a convertible bond. So I use the other feature of the convertible bond, which I can convert into stock, and I hedge that scenario too. This is good risk management. Sorry, good risk mitigation. And the result of that is you're going to have a better trade than any stock trader, any bond trader. And it's called convertible arbitrage because it's not that it gives you return without risk. It gives you return with better than normal risk because we've managed to hedge the main risk. In the previous example, the risk came from the first eigenvector index. Here, the risk comes from either the stock doing too good or too bad. It's tail risk. Both sides of the tail. If you have a convertible bond and the company does too good or too bad, if you're buying the bond, the tails will kill you, no matter what. You pray that this company doesn't do anything. Like, just stay the way you are. Otherwise, you're going to lose money. If you just buy the convertible bond. But even in that case, you only collect your coupon payment. Big deal. How profitable is that? Not even Yun Chin will like it because it's too little for your appetite. This gives you a chance of making money on the tails. That's what I want you to understand. Yes? Yes? Okay, so having said that, I want to now tell you a bit of a story. You understood convertible, I understand. But now I want to bring your knowledge into the real market and show you how powerful you are now, how much you know. And I'm going to show you that what you now know is more than many % of what the world knows. Let me tell you what happened in 2008. I don't know where you were in 2008, maybe in elementary school, I don't know. Yes, so you didn't care about convertible bonds, you didn't care about financial markets, you just wanted to, play ball or something, I have no idea, okay, or just wanted to eat, I don't know. But the world was coming to an end. It was very bad. A very big credit bubble had grown over a period of, say, 5-6 years, and it was ready to burst. And the result of that were going to be very, very bad. The first casualty was these 2 hedge funds that I told you from UBS. And then there was a call for attention for the financial sector. Say, what's going on? Why did that happen? Then people looked into it and said, oh my God, look at all of these CDOs, credit default obligations, that had packaged all of these mediocre bonds that if they defaulted at random times, they would have been okay, but they all started to default at the same time. They were all subprime and they're all based on very dodgy properties. So, and then what do banks do? Banks issue Mortgages is a very safe business, right? Good collateral, good fees, perfect. Let's just do that. How much? As much as you can. People were able to buy 5 homes and they got mortgages for 5 homes. And the risk seemed to have disappeared through the intervention of the CDOs. So then the banks started to see that they had a lot of problems. And what do banks do when they have problems? What do they do?
They try to offload it from their books.
No, they borrow money. They issue bonds. That's what they do. We went through that earlier, right? They needed money. They, by the time to offload from the books, you need to find some ignorant people who will buy them from you. But they have already done as much of that as they could. By the way, that's one of the reasons Germany was so upset with the United States, because Germany bought a lot of that junk. But at that point, what are you going to do? Fly to Germany and try to sell some more? No, I mean, you were done, okay? So banks needed money. They needed to be capitalized. So what do? They issue bonds. They issue bonds, and people didn't want the bonds. And they gave bigger and bigger and bigger yields. I know of a bank that was issuing bonds at a 25% annual yield. 25. Rates were like 3. 25. Free money.
Which name was it?
I forgot. It was some regional bank in the United States. I forgot the name. I can find out. 25%. No one wanted it. Then what do? Tell me. You show me you've learned something. I cannot hear you. I cannot hear you. You said something that sounds interesting, but I couldn't hear you.
Convertible bonds.
Not yet. No. You skipped a step, right?
First you offer stock.
Exactly. You don't skip a stock. You learn something. You issue stock, and they did that. They spent all of 2007 and most of 2008 issuing stock. And at the beginning, people bought stock. Oh, it's cheap stock. Let's buy it. It's good. But then, what happened? They needed more and more and more. So they needed to issue more and more and more stock. And at some point, there was just not enough stock to issue. They couldn't issue more because the stock was so cheap. They have to issue enormous amounts of stock, diluting the existing shareholders. That made the existing shareholders very scared, and that fear spread to the people that would buy their stock. So they couldn't do that. Around summer of 2008, they couldn't do that. And then the Big Bang happened. September 14, 2008. Lehman Brothers went bankrupt. Not all of the Lehman Brothers, just the division of Lehman Brothers, the one that was dealing with essentially commercial real estate, went bankrupt. It was actually allowed to go bankrupt. The Fed refused to bail them out. They had bailed out Bear Stearns earlier that year in March. But something was going on with Hank Paulson, the chairman of the Fed, and I only can speculate what it was, but I don't know. So it was let to go bankrupt. The financial markets were okay. Everybody had calculated their risk. I think we're okay. What's your exposure to Lehman? It's so-so, it's okay. So everybody thought it was okay. September 14. I was on a flight to Athens to attend the Morgan Stanley European Hedge Fund Conference. I boarded my flight in Toronto at 10 p.m., 9:30. Make my last phone calls. There was no internet on the plane back then. Looks like we're okay. We're okay. All right. See you after Lehman goes bankrupt, because everybody knew they were going to file for bankruptcy at midnight on the 14th of September. I land in Frankfurt a few hours later. First thing I do, check my messages. It's okay. Everybody's sleeping in Toronto. I don't call the office. I check the Frankfurt market open. It's okay. No problem. We survived the bankruptcy of a very big bank. This is not Silicon Valley Bank. This is a very big bank. I catch my next flight to Athens. My first time in Athens in my life. I land in Athens, check my phone. It's okay. Get into my taxi to go to my hotel at the conference. And I start to get some messages, which is, it looks like AIG, American Insurance Group, had issued a lot of credit default swaps on Lehman. An insurance company had lost about $80 billion. And this is not just an insurance company, it's the American Insurance Group. It's one of the biggest insurance companies in the United States. So they're going to go bankrupt on Monday. And now the question is, all right, AIG goes bankrupt. Who has issued credit default swaps on AIG? Now we're talking about a multi-billion-dollar company. Is that Goldman Sachs? Is that Morgan Stanley? Is that JP Morgan? Who's next? And who's next after that? And who's next after that? Understand? So, emergency situation. Hank Paulson, the same guy who allowed Lehman to go bankrupt, goes to Congress, writes very quickly a letter and said, I need emergency funding, $80 billion to bail out the company. US Congress said, are you crazy? No way. And you said, you didn't send me a 1,000-page report. I said, I need it by tonight. Understand? In the meantime, financial markets like going crazy. Stocks going down and this and that. All right, I'll save you the details. The rumor was that Morgan Stanley was going to go bankrupt next. And there I was at a Morgan Stanley conference in Athens. All of the Morgan Stanley executives who had announced they were going to come and tell us wonderful things, none of them was there. They had sent some people, junior people, to read a few words. And they held this conference on a beautiful rooftop bar in this hotel. And these guys were reading those wonderful words written for them by the top executives somewhere in London or New York. And it was just funny. There was a storm coming. And it was a rooftop bar. And they would be reading a statement. There was clearly an exaggeration as to how well they were holding and how much liquidity they had. And then the wind would come and would take a chair and just crush it against the floor. It was like that. It was like a wonderful movie. I was in that movie. You know? And it was bad. It was very bad. And then what do the banks do? They need the money. They need to survive. What do? You tell me what they do. Convertible bonds, right? Like, take whatever you want. Just give me money. I don't care what you take. All right. Turns out that the geniuses at the regulators in the United States and in England on September 17, after hours, they decide to issue a short selling ban. You cannot short sell you cannot short sell stocks of banks. What do you think happened? You tell me. First reaction from the market. Stocks go through the roof. On Friday, September 19, Every hedge fund manager who was, they were all short banks. They were like livid. Banks opened at 2 times valuation on Friday. They were losing 100% of their banking positions. But that was not the worst part. The worst part is that people were buying bank stocks, but no one was buying their convertible bonds. Why? You tell me. Why no one was buying their convertible bonds?
Stock is growing.
Hmm?
Stock is performing.
No.
Because they couldn't secure it with the short.
You couldn't short. The people that would buy your convertible bonds, they say, I'm not going to touch this. If I can short the stock, I would. But, right? We just saw it here. If you buy a convertible bonds are very risky. You can only buy them if you get some sort of protection. And it's tail risk protection. That's what we saw here that you can do. So yes, stocks were going up for a while, but the bank assets were going down. It didn't work. You would do a better job than the regulators. You understand? This is history, and now you need to feel powerful that you're on top of it. You would have been able to say, my God, what are they doing? Right? The market is going to fly away. And it was bad. And it was bad all the way until March of 2009. It was worse and worse and worse. So finally, one of the banks that was worst hit by all of this was a bank called Citibank, that everybody called Shitty Bank. The stock one day dropped to 99 cents. If it had stayed at 91 cents, it would have been kicked out of the New York Stock Exchange. They don't accept stocks less than $1. That's how bad it was. But now, at that time, I guess, people have learned their lesson. So the US government, the Fed, in fact, went and said, okay, we're going to do a deal. And this is the deal. We're going to do a deal. You issue convertible debt. We'll buy it. No hedge, obviously. The government cannot now go short Citibank, right? Not only because they had banned short selling, but because, you cannot, their positions are public. The bank, the Federal Reserve Bank cannot go short one of their banks. You can't do that, right? We'll buy it. Oh, investors were thinking, we were one of them. Oh, the central bank is buying that convertible debt. And that was open to the public. We could buy it too. So if the central bank is going there, you would think that it's a bit safe, right? So we went in, but we hedged. We were allowed to hedge, and we hedged. We went short. The stock was not at $1. To go short at $1 is very painful. You still do it because, right? The stock was $4. I have all the numbers here. It's not so important to go through that. But the stock was at $4. We shorted at $4. It was a profitable trade, very profitable trade. Despite a short at $4, the stock went to 12. We lost in the short a huge amount of money, but overall we still made money. It was great. It was great. But the interesting part is this, and this is what the public also does not know. We made money with a horrible hedge, where we lost 300% on the hedge. The government didn't hedge. It was a very good trade for the government. For the Fed, it was a very good trade. It is true the Fed bailed out many of the banks, but bailout means this. And in this particular case, the Citibank bailout, they make a lot of money. Right? It was a very good investment on the part of the Fed. You understand? Well, this thing.
Why didn't they hedge? Was it not allowed for them?
No, come on, you can't do it's. Imagine the German government going short Deutsche Bank.
Just a bad thing.
You can't do that. Or going short Lufthansa. Or it's what do you know that we don't, right? And how that gets to the press. How would people twist? Say, no, it's really a hedge. Is it hedge? What's hedge? What does that mean? Right?
Yeah, true. Yeah.
If the United States had 250 million people like you, then sure, maybe they would have done something different. But that's not the case. They can't do that. Look, the Congress didn't understand what was going on, and Congress does not about hedges. No, they couldn't do it. No. I'm telling you, you know more than these people. Much more than these people. So I have the story here. Okay?